All right, traders, let's keep it going with none other than, of course, Ryan Detrick, Chief Market Strategist at Carson Group, or should we just call him Statman by now? I mean, we all know he comes always prepared, and he has a deck, of course, ready for us. It's always good to have you, Ryan. I know that you are and I got to give it to you. In my eyes, I look at a lot of analysts out there. You're the number one in the stats game.
Well, someone's got to be, I guess. But no, it's an honor,
take
Mitch.
it when you can, right?
That's right. It's an honor. I know I've been on with you guys a ton this year. Well, honestly, for years, but this year you've had me on a lot, and it's an honor.
Yeah.
And I'm glad to be back to talk a little bit about what we just saw and maybe what we're going to see next year. So thank you for having me.
Yeah, like before we get into that, just talking about stats overall, Ryan, what is it about stats overall that get you, and that's like your way of looking into the markets?
Yeah, I mean, boy, I could give a hour-long answer here, but I mean, I started using social media in 2009, and what I discovered when I do tweets and things, people really liked, hey, the last 5 times this happened after it. And I kind of just made a move into that realm of looking at where we've been for a potential path to where we're going to go. And I've massaged it over the years using technicals, using sentiment, using fundamentals, looking at macro. But at the end of the day, I think that's what kind of people gravitated towards me, looking at seasonality and certain things like that to just kind of tell a story. End of the day, I'm a market strategist, and I think my job is to tell a story. And I get to work with financial advisors and their clients every single day. And this stuff's confusing, but you can also make it as confusing as you want. So I try to just take complex things and make it easy to understand. And sometimes, a simple stat like, hey, a pre-election year is usually pretty strong. And then you back it up, and here we are where it's actually kind of played out. It doesn't always work. Believe me, I get it. When you stack enough of these, Mitch, on top of each other, like a year ago when I came on with you guys saying, listen, there's no recession, probably going to have a good year. People thought we were crazy. But again, there are a lot of bullish points happening this time a year ago that sometimes this stuff can work.
Yeah, and I think sometimes, with all the confusion that's out in the world,
Yeah.
sometimes when you just can bring it to the stats, it can make it a little bit clearer. Let's talk, of course, about the chaotic journey of 2023, where AI's evolution and the shift from the bear market was very pivotal. What standout trends and events influence the market's trajectory, and how might that play into 2024?
Yeah, I hinted at a little bit. I know the first slide I'm showing here. I mean, just, what did we look for last year at this time? Like literally the first time in history, market strategists were looking for negative stock returns. Well, we had a 20% drop in the S&P 500 last I checked in 2022. It had been extremely rare to have stocks down 2 years in a row. Could it happen? Sure, it can happen. 73, 74. 3 years after the tech bubble burst. But if you could avoid a recession, and some of the positives we were seeing on the consumer front told us there was no recession coming, just that over the top negative sentiment. I think, we could do this in 10 years. We could look 10 years before. If the crowd is always thinking one way, the opportunity could be the other. It doesn't mean the crowd can't be right. I want to be very clear there, but I think it's the opportunities. And then, of course, I'm sharing the playful, is this the next Warren Buffett? I mean, obviously not. The guy sitting in a jail cell right now. But I think it's just, kind of just be aware that there's no one that's always right. There's no one that's hopefully always wrong, to be honest, either. But there's always going to be these opportunities. And once again, this year was just full of opportunities because so many people doubted. I mean, in March, you had the regional bank crisis. In October, we had the market in a correction down 10%. Those are normal things. Most years have worries. Most years see stocks pull back a little bit. I mean, it happens. And just the amount of fear that continues to come in is what's fascinating to me. And from that contrarian point of view, kind of been a reason we've said, we're probably still going higher. We still think we are.
Hey, not a bad side to be on, right? It seems like it was the right side. Let's talk a little bit about the statistics, right? Of course, you've mentioned this throughout the whole year of 2023. It's not like something that's brand new to us, but I always think it's one of the most important stats that you bring to us is the statistics on presidential cycles, right? And how next year will go. What does the pattern suggest? Is it a bullish, bearish sentiment for the market? How do you see it, Ryan?
Yeah, good news. It was very, very bullish this year, and it's moderately bullish next year. So the slide I'm showing now is literally one I think I've shared with you guys for like a year now, but I just keep dusting it off, and it makes sense. This is the 4-year presidential cycle broken down by quarters. Well, it's normal to see a strong fourth quarter in a midterm year. That's what we saw last year. It's normal to have a lot of strength early in a pre-election year. Everybody knows pre-election years are normally pretty strong. It's not perfect, I get it, but normally pretty strong. Most of those gains in the first half of the year, everybody and their mother was saying, 2023 is not going to be that great in the first half. It's the second half. Things are going to get better. We said, wouldn't it be something if it's the opposite of that? That's kind of what's honestly played out here. But again, that's this chart. But what I want to focus on here is the next one. This is, again, looking at the third year of a presidential cycle, actually all 4 years. What I think is interesting, Mitch, midterm years usually aren't very good when you have a new president. Well, that checked the box this time. Yeah. But then check it out. You're up like 20% on average when you have a first-term president, that third year of a presidential cycle, where we are right now. What about next year? And again, there's a lot of other stuff to factor in. I want to be very clear, but it's just the big picture stuff to think about. Next year, up 12.2% on average. You have a first-term president. Oh, by the way, the last 10 presidents, election years were higher when it's their first term. So again, it's just one of those, it is what it is. We still don't see a recession next year. I got some other stuff I'm going to talk about soon. This is just one of those things when everybody, red and blue and election years, everybody, their heads explode because they either love who's in office, hate who's in office, whatever it is. I just want to be very clear. You should care, of course, about what Washington's up to. Want to make that clear. You should vote and do all that stuff. But when it comes to your investments, one of the best things you can do is, I hate to say this, almost ignore what Washington is up to, because again, a lot of people hated, President Trump. Stocks did well. A lot of people hated President Biden. Stocks did pretty well. A lot of people haven't liked, President Biden, President Obama. Sorry, President Obama, didn't like him. Stocks did well. We've had opportunity on President Biden. So I just want to be very clear that this election year is probably going to be pretty darn good because the economy is going to be better than people think, and it doesn't really matter who's in the White House. I mean, it's a sad truth. Maybe not even sad. It's just the truth, the way this stuff works.
Yeah, and the numbers don't care, right? Yeah. The numbers don't care. So I think that's an important outlook here that you're bringing, Ryan, is that the numbers aren't telling us that it's Republican or Democratic, that's why I need to get in here. It's just more along telling the cycle.
And I'll just jump in. I don't have this, but it's, the definition of gridlock, right? When you have a very close House and a very close Senate, like we do right now, you're not going to have these big sways. You're not going to have major blue waves or red waves with all the different things that whatever party believes in and spending money and pushing it through. We have gridlock right now. We're probably going to have gridlock again in a year when all these elections come through. I'm not sure who's going to win the election. I'm just saying the way the House and Senate make up, when you have gridlock, that can be a positive thing, and stocks tend to do well. A lot of other things to look at, sure, but again, gridlock can be a good thing when it comes to Washington.
Of course, we had the Magnificent Seven or the Elite Eight. I know some people like to refer it like that. The narrative of that it heavily influenced the 2023 rally, right? And do you foresee these stocks maintaining their dominance, or do you anticipate a broader market surge taking precedence? I think we're already still seeing some of that right now.
Yeah, we think of more broadening out. I mean, yes, those 7 stocks are a big deal. I mean, you look at technology, communications, both up, 40% for the year, maybe even a little bit more by the time people hear this. So great years. And a lot of those stocks did that. But we hear, it's only 7 stocks. It's only 7 stocks. We've disagreed. I mean, literally a week ago, the NYSE advanced decline line made a new all-time high. It's hard to think only 7 stocks are doing that when it's looking at the whole, the whole package there. The chart I'm sharing, though, is a really interesting one. It's how many stocks are making a new 20-day high. Okay, a couple Fridays ago, we saw more than 60% of all the stocks in the S&P 500 make a 20-day high. That doesn't sound like just 7 stocks to me. That sounds like a broadening out. It sounds like a lot of stock participation, a lot of stocks going higher. What does it mean? Well, again, it's one of those, it is what it is. Thanks to data from our friends at Ned Davis Research. Went back to 1972. That's how far back they had data. That's what I did. 1 year after you see these big surges in stocks making a 20-day high, Mitch, the S&P is higher 15 out of 15 times. And let me just glance. What is it? It's 18% on average a year later. Now, again, who knows? But hey, you start stacking these things on. I've mentioned some of these other numbers before. If you follow me on Twitter, X, I've pointed these out. But this is a really powerful one to me when we kind of said, 7 stocks. I'm not so sure. And this broadening out theme is definitely one that we like. Small and mid caps. I'm going to talk about that in a little bit here. But we do see this market broadening out, which is not going to be the end of the world. Just the other day, we had all 7 of those stocks down, but the stock market up. That's pretty darn rare. But again, maybe it's a sign that, the times are changing a little bit. I'm going to be very clear. We're even with technology. We are a tad overweight communication services. Okay. So we're not I'm not saying I hate these groups. I'm just saying there's probably some better opportunities in some of these other areas. Last comment, a year ago, who really wanted to own tech? Honestly, I didn't. I didn't want to own tech. A lot of people didn't, okay? And look what happened. Tech communications did amazing. So just because something's hot now does not mean it's going to be hot in 1 year. I know we know this, but when you're in the midst of it like this, sometimes it's hard to remember that. So there's going to be some broadening out and a lot of opportunity. We think some of the underloved areas when we get back here in 12 months, in our opinion.
I had this a little later, but I think it's important to just add to that point right now. Let's
Mhm.
talk about identifying potential outperformers. And
Yep.
of course, that's vital, right? Every year we're looking at like the top 3 sectors and the
Mhm.
bottom 3 sectors and wondering, if we're going to get some top performers to stay there,
Mhm.
or
Yeah.
maybe will we see a little bit of a shift? We all know what happened last year. I mean,
Yeah.
if you were betting against technology this year, you didn't do so great, right?
No. Well, exactly. Yeah, it would have been a rough go of things if you're I don't know, if you had a shirt that said something like "I love utilities and I hate technology." It's been a rough go of things in 2023. But again, what I'm sharing here, and this is hopefully I can use the F word. This is fundamentals. I know we have more traders on this, but if
Whoa.
you think about it, the stock market's expensive. The stock market's expensive. There's probably a lot of people listening to this. They're not so care if the stock market's expensive. You're only holding things for 1 to 3 months, maybe even shorter. But I'm a little bigger picture guy. And I'll say this much. Yeah, stocks are a little pricey. Okay. Look at technology communication. That's what I'm sharing here. I mean, they are pricey when you look at kind of where they've been historically. But here's the thing that's interesting. Small and mid caps are really cheap right now, like historically cheap relative to large caps. And okay, just because something's cheap, believe me, I've done this for 22 years. I think for 22 years, I've heard emerging markets, they're pretty cheap. They haven't really done all that well for the last 22 years, last I checked, relative to the rest of the world. So just because something's cheap doesn't mean we want to go into it. We want to look at it a little bit. And I know I've got some charts and we'll talk about inflation things. We see a lot of reasons inflation is coming back down. The Fed is likely done hiking. These headwinds, these higher interest rates, which just crushes a strong way to put it, but really put a hamper, I guess, on small
Yeah.
and mid caps. That's out of the way. So to answer the question, I'm just going in circles here. The answer, we are overweight small and mid caps. We also like financials a lot next year. We like industrials a lot next year. We do not see a recession. We think those are those cyclical areas are the ones, and even energy. Energy's, boy, those stocks, they've been hit pretty hard, right? I mean, maybe there's some opportunity there as well in this big pullback we've seen. So we like the cyclical areas with a tilt to small and mid caps because again, those are the areas that are kind of cheap but have some fundamental drivers, which were headwinds a year ago. What the Fed policy did, interest rates, now they're a tailwind. And by the way, last I checked, small and mid caps, they tend to be how your domestic economy is doing. We think the economy's on pretty firm footing next year and don't see a recession. So we think there's going to be a big catch up in small and mid caps next year.
And I think all eyes will be on kind of looking also to the January effect, see if that
Yeah.
kind of starts it going. A lot of times we see that get those small caps going, but it's definitely
Mm-hmm.
an area to watch. I mean, you
Yeah.
said it right. I mean, it used to be kind of hampering, and now it could be a
Mm-hmm.
tailwind of the
Mm-hmm.
new current environment. Let's go, of course, to monetary policy. What shifts or strategies are likely to unfold in the response to potential inflationary pressures? And will we get the famous pivot in
Yeah.
2024?
Yeah, short answer, we think there will be the pivot. I mean, the Fed is not always right. I get nobody is, okay? But I mean, literally 2018, Powell's talking about, we're pretty good where things are. And then all of a sudden he starts cutting right away. May of this year, they were, or I guess May of 2 years ago. No, it was May of this year. They were talking to Powell about, or it was 2 years ago. Sorry, I'll get there. They said, hey, you going to do any 75 basis point hikes? He was doing 50. They said, I don't see any coming. Like literally the next month he did a 75, like 4 in a row. Okay. So let's just be very clear here. The Fed's not always perfect. And what they're saying now, we think they're giving some of the tea leaves that inflation is coming back. We continue to see the inflation data. I've shared the one on the left with you guys a lot. It's Shelter. Shelter's been that stubborn part of overall inflation, but the private data, rents, and Zillow, some of those places are showing negative year-over-year rents. That's working its way into some of the government's data. So as Shelter begins to crack down, we don't see too many issues. And on the ones on the right, you got 6-month CPI change and also ex Shelter. I mean, the bottom line is inflation. I hate to say, was it transitory the whole time? Maybe it just took an extra year to work through all the supply chain issues and things, but inflation is coming back. And that leads to the next question on this next chart here. It's this big theme we have next year about productivity. All right. We haven't had great productivity in our country for a long time. One of the last times we had good productivity without a recession. I mean, think about 2020. We had high productivity. That's because like everybody lost their job. And if you're fortunate enough to keep your job, you were doing a lot. You were working really hard. So you were more productive, but that's not the way to keep the economy going. So right now we hired 5 million people last year, another ballpark 2.5 million people this year. People were quitting their jobs like mad a couple of years ago. Now people are where they're supposed to be, I think now, and they're sticking around a little bit longer. People are happy with their jobs. AI is out there as well. There are some big time similarities with now in the mid 90s. Mid 90s, of course, was the last time we saw strong productivity amongst the internet revolution, which was coming. And Greenspan saw that. One of the things about 94, Mitch, the Fed hiked rates a lot in 94. You go back in history books, that was one of the worst years for bonds ever. Believe me, these last couple have been worse, but that was a bad year up to that point. Then productivity was high. Greenspan understood with high productivity, I just hike rates a bunch. I probably can cut interest rates, but we won't go into a recession, because the last couple times we cut interest rates, what happened? Well, we were in recessions. I mean, pandemics, a financial crisis, lots of bad stuff. But now we finally have really impressive productivity coming. When you have strong productivity, the Fed can cut. Usually you can keep wages higher, and you don't have higher inflation issues. In the 70s, we had high inflation, but really low productivity. So to us, put a bow on this, if productivity increases like we think it can into next year, that opens the door for the Fed to pivot, for the Fed to cut. We don't think they're going to cut a ton, maybe 3 or 4 cuts, probably starting middle of next year. It's an election year, all the stuff that comes along with that. But again, what did the market do in 95? For those of you with your history books, take a look. It sniffed out the Fed cuts well ahead of time, and 95 was an amazing year for stocks. We don't know if we're going to gain 30%, I think 35% back then. I don't think we're going to quite gain that much. We think potentially, low single digit returns is what we think is possible next year with, again, bigger returns, small, mid, financials, industrials. But there's a lot of opportunity here if productivity is strong to keep this economy driving and going forward. And again, inflation in check, wages higher, and they can cut some interest rates, which are going to help the mortgage market, which has really upset some things. So there's some real positives out there, I think, if you peel back that onion.
Definitely keep your eyes on that productivity. Nice mention there. Let's get to weeks ago, of course. Tons of prediction coming for 2024 recession, right? They were being yelled out on the street. Everywhere you looked, you could hear it. Now there's some discourse, right? Now some of them are mentioning a mild economic downturn. Are these varying analysts' opinion missing the mark, or is there substance to these revised forecasts?
Well, I mean, there's always some good info if you look a little closer. But I'll just say this again: we don't think there's going to be a mild recession. We don't think there is a recession. Everybody keeps talking about the landing. We were on record saying there wouldn't be a landing because the plane had plenty of fuel, and sure enough, here we are. I mean, what I'm sharing on the screen here is just simply forward estimates on the S&P 500 looking at record earnings next year. Now, again, that's estimates. That can change. I get it. Also, profit margins have stopped going lower and started to improve, which is a positive. Also, 12-month CapEx expenditure expectations are high. And this year, clearly housing's been a major drag. The Fed hiked interest rates. We saw what's happened in the housing market. Manufacturing's been weak-ish, but there are some positive signs. I'm going to end with kind of talking about some of those. But the consumer's been the strongest part, right? Still making 200,000 jobs every month. I mean, everyone's upset with inflation. We get it. You look at the polls. What people care about more than darn near anything, it's inflation. It's paying more for stuff. What people tend to forget, though, is they're actually making more than inflation. I mean, and not always, I get it, but in a lot of cases, real incomes are all-time high. Net wealth is at an all-time high. Yes, prices cost more than they did 3 years ago to do most things, but a lot of people are worth a lot more, and a lot of people made more money. So again, that was one of the reasons a year ago, Mitch, we were saying there wouldn't be a recession because the consumer is still strong. So when you stack all these things on top of each other, it just still says, I hate to say it's all the Fed is like, let's give them a gold medal. I don't think they really did that great of a job. I mean, they're probably behind the curve a couple different times, but at the same time, the consumer really deserves the gold medal because they've continued to kind of keep this economy afloat amongst the higher interest rates. And now rates are hopefully going to start coming lower. It's not perfect. There's some people that are obviously struggling, but again, there are still just more positives and negatives in our opinion. So the mild recession camp, we would take the other side of that, or whatever the other side of that is, and say there's really no recession coming in our opinion, led by record earnings, which last I checked, usually you don't have a recession. Oh, by the way, when your stock market makes all-time highs, you can have a recession after that. I know there's some times in history, but the majority of the time when the stock market makes new high, and last I checked, the S&P had made new high for like 2 years, okay? I mean, I think it was January 2nd, 2022. We're like 5% away. So we're going to hopefully make one soon-ish. Usually you don't have recessions when you go a couple years without a new high. That's just some other things about the market tends to lead the economy, and I think the strong stock market is telling us the economy is going to be better in 2024. Kind of hard to say. 2024, right? That's the next year, right? Yeah.
All right. I asked some of the other analysts this question and experts. You say the consumer gets an A. What does Powell really get if you had to put a grade on him?
Oh, I'd say C. I mean,
Okay.
He says one thing, doesn't. The funny thing about Powell, his very first day in office, I believe, was February 5th, 2018. You can go back and look, whatever it was. The Dow dropped 4.6%. That was his first day in office. Now, that was when the whole tariff thing started. That's not because of Powell's first day in the office. I'd say his first day was an F, so he only had one way to go, was up. Worst first day ever. And by the way, the Fed, happy birthday to the Fed. By the time most people listen to this, the Fed will be 110 years old. December 23rd, 1913 was when the Fed started. Now, I'm not even sure if I hate to go down this rabbit hole, hole. Is the Fed really done more good than bad or bad than good? There's two sides to every story here. But yeah, I'd say a C or so. I mean, what I do like about Powell, he really seems like he's just telling you what he thinks. Okay, there's all these different Fed members giving their opinion. I mean, there's so many different Fed members I didn't even know existed because they're all over CNBC talking about it. But remember, Greenspan, he loved talking a whole bunch but saying nothing. I think Powell understands, I don't need to do that anymore. We're being more upfront about things. And again, I think, they've done an okay job. I mean, we've avoided a recession. I mean, that's obviously a good thing. And I don't know if it's because of the Fed or exactly why. But at least, we'll give him maybe, you know what? I'm in a good mood. Let's give him a C+. How's that sound? Yeah.
All right. You'll get the plus, Jerome. I think he'll be feeling good about that one. He'll tell his mom it's almost the B, right?
Almost.
Finally, how would you summarize, of course, your overall outlook going into 2024? Will the optimistic win again in 2024?
Well, I mean, you look at history, and the stock market is up 7 out of 10 years, up 9% on average, right? I mean, you're more likely to have a 20% gain in a year than you are a down year. Go back to 1928. There are more 20% gains for the year than there were negative years. So I think it makes sense to always be a little bit on the optimistic side. Now, sometimes you want to be a little worried, or not worried. You want to be a little cautious. We're not so sure. I mean, we've been overweight equities for like a year now, and the money that we run for our Carson partners on the Carson Investment Research team, we're still overweight equities. We just add a little more equity risk on that pullback in October, and everybody's freaking out saying we're market in a correction. We added it. So we're putting our money where our mouth is. Now, one final thing I want to talk about, the future is bright, sharing this chart here. I work with a really smart guy named Sonu Varghese. He's our, I'm sure I get his title right, Chief Global Strategist. I'm pretty sure it's his title. Just Sonu. Not too many Sonus out there in the financial world. But Sonu, he said these are his charts of the year. Just a complete and utter manufacturing boom has been taking place. People aren't really talking about this. Look on the left, the boom in manufacturing, and then in chips. Yes, a lot of this is the CHIPS Act and certain things bringing things home, not letting other countries kind of create these high technology things. When you have an issue like a pandemic, well, maybe we want our rules, our regulations. So we are bringing this stuff home. But I mean, everybody likes to rag on the government. And trust me, I'm just probably guilty as the next person. But I'm not so sure all fiscal policy is bad. The CHIPS Act and some of the things that we've seen, think about the productivity and some of the things that are going to take place with all these manufacturing and construction that's going on right now in our country when we actually get the benefits of those things down the road. I think it's going to be really, really positive. And manufacturing, I think, Mitch, is like 11% of the S&P, of the overall economy, right? Consumers, 2/3, there's housing, government spending, all that stuff. So manufacturing is not a huge part of it. It used to be like half. I mean, back in World War II, not a shock. Our economy has changed. But I just want to be very clear here. I think, there could be a big part of manufacturing. If it's that canary in the coal mine, there's going to be some positives coming from manufacturing next year. And this is one final comment. We've talked about this before in our shop. So the consumer did great. Maybe the consumer does slow down a little bit. I mean, delinquencies are coming up a little bit. Rates are high. I just bought a car for my daughter. She turned 16. I'm like, oh my goodness, that car does cost a lot more because I saw it real world when you buy a car 2 years ago compared to right now, what interest rates can do to that payment. I see it. I felt it as well. But maybe the consumer pulls back a little bit. But maybe because rates come back down, mortgages come back down, housing could just really be a big explosion in economic growth. And manufacturing, which has been a drag, let's be honest, could be a big plus as well. So again, that's just kind of that moving around, sloshing around a little bit, but still overall, the economy still is positive to us. We'd still side with the optimistic. Again, for this year, we do not see a recession. We see potentially new all-time highs. I mean, I want to be very clear there. But also, we're looking between 11 to 13% on the S&P 500, but more from small, mid-caps, financials, and industrials. That's how we're positioning our models. And it can change, I mean, if the facts change, I change my opinion. What do you do, sir? We've all heard that comment lots and lots of times. Maybe I'll change my opinion in 6 months, but that's how we see the world right now in the Carson Investment Research team.
Statman, Chief Market Strategist at Carson Group. If you're not following Ryan Detrick, especially on Twitter, I don't know what you're doing in the financial space. Always coming with the stats. You guys see the charts. And we'll, of course, see you next year, Ryan. Get after it. Enjoy it. Thank you for what your coverage did for us on 2023. Definitely uncovering the markets, giving us some great stats. Looking forward to what you're going to do in 24, Ryan. Take care.
Always enjoy joining you guys. Usually it seems like it's Thursday morning. I don't know if that's random or not. Usually it's on a Thursday morning. I look forward to doing a lot more into next year. And I mean, believe me, hope is not a strategy. I want to be clear, but hey, let's hope this bull market keeps going. I'll just put it like that. So thanks, Mitch, for having me. I appreciate it.
All right, traders. Of course, we just talked to Ryan Detrick, so I thought none other. Let's go to the next best presenter that I know, right? I mean, we've been seeing her really kind of grow in the financial industry. One of our biggest guests for pre-market prep all year. Let's bring on Cameron Dawson, of course, CFA, Chief Investment Officer, NewEdge Wealth. And it's been a great year with just getting your perspective. You know, one of the things is I think that you really taken Wall Street by storm, Cameron. So I wanted to give you that feedback. And it's really something that's impressive.
Well, I'm humbled that you would say that, and I'm really grateful. Goodness, is this fun? I think it's the coolest job in the world to get to watch and follow markets every day, and then get to speak about it. And get to speak to people like you. So thank you so much for having me.
Let's go ahead. Let's kick it off, of course, with the current market sentiment being cautiously optimistic, right? How concerned are you that the potential of overvaluation and the subsequent market correction could be coming, and what factors might actually trigger a scenario like this?
Yeah, I think one of the most important lessons that we've learned really in each of 2022 and 2023 is just how important positioning and sentiment and valuation are for markets. And I think that when we look at the start of 2022, we saw that positioning, sentiment, valuation were all very stretched. And it just created a very high bar for markets to jump over. So when you added things like a tightening Fed and tightening liquidity, the end result was that markets really had nowhere to go but down. The opposite, of course, was true in 2023. One of the things I think we underestimated the most in 2023 was the ability, because positioning was light, valuations weren't that low based on history, but they were definitely lower than they were in 2020 and 2021. But that you had gotten to the state of being washed out. Positioning light, sentiment was really washed out. You saw that in a lot of sentiment measures. And then what you had then was a scenario where you had a low bar to jump over. So we're really aware of what these factors are doing today. And what we can see is that the market is in a state where positioning and sentiment are now optimistic and overweight, or overweight and optimistic, but they're not quite yet at extremes, meaning that if you can compare back to end of 21, early 2022, of course, you have very different leadership within the market. Valuations aren't as stretched during that time as well, but you do have to be aware and cautious that if we continue to see markets drift up with extraordinarily low volatility, that the risk you run is that people get complacent. It's the classic Minsky moment. It's low volatility creates the scenario for high volatility. And we've experienced this in other times in the past, right? The blow off top in late 21, early 2022, times like early 2018, where we had a blow off top and then a flash crash of volatility right after. And so I think when we continue to look at this market, it'll be really alluring to believe every narrative, the narrative of the soft landing and AI and unending earnings growth. But narrative only gets you so far, and that's where we say, yeah, we think the market can continue, has great momentum. It's like, it's responding well to overbought conditions. It has some buying thrust that's been happening. But once we roll into 24, watch sentiment measures, watch positioning measures, and then you roll that into valuation. And it's when you get that trifecta of all of those things being elevated, that's when those dynamics become a risk in and of itself. So the message here is, elevated, but not extreme, but could be on their way to extreme sometime in 2024, which is just something that we should watch very closely.
Seems like there's a disparity right now, of course, with the market's expected rate cuts and the Fed's more conservative approach, right? What do you think ultimately happens here? Will we get the famous pivot in 2024?
Yeah, look, I wouldn't be surprised if they did some tweaks to rate cuts. It's 100% priced in at tweaks to the level of rates, meaning deliver some cuts. The question is, do you see the Fed actually deliver the cuts that are being priced in by the bond market and are being forecasted by many forecasters? I just heard different people today forecasting 125 basis points of cuts. That is an aggressive assumption if you do not assume that the economy weakens. Because if you look back in history, the Fed has never, ever cut more than 75 basis points without there being some kind of recession condition. The other interesting thing is that even when they were cutting by those 75 basis points in periods like 1995, 1998, and 2019, the Fed was afraid of a recession at that time. They were afraid that there were different factors, whether it was the long-term capital management meltdown in 1998, or you had the bankruptcy in Orange County in 1995, 2019, we had a trade war. They were worried about a recession when they were cutting rates. The conclusion, though, from that is that the market, by the time they finished those rate cuts in each of those scenarios, had hit a new all-time high, with effectively equities saying, yeah, we don't believe it. There's no recession here. And so I think that the mindset that we're approaching this is one where we say, yeah, they could cut rates. We could argue that a lot of those rate cuts are already firmly priced in, whether looking at equities, looking at with valuations where they are above 19 times, 19.2 times right now, kind of reflecting some easier policy. But of course, looking at futures markets as well. And so if we get rate cuts, but no hit to earnings, probably good for risk assets. But if we get rate cuts that come with some kind of economic weakness, that's when you're cutting your earnings estimates. That's when the rate cuts, you're not cutting for a good reason, which is falling inflation. You're actually cutting for a bad reason, which is falling growth. And it just comes back to this idea that not all rate cuts are created equal. You might get some, but you probably don't get the full extent of what's being priced in. The last point in this, though, is do markets even care? We started the year with the Fed pricing for December of 2023 of a market expectation of 4.5%. We're ending the year now of that market expectation of over 5%. So you've had a year where expectations for the Fed have been tighter, more hawkish throughout the course of the year. And yet growth stock valuations, tech stock valuations are all up over 40%. We've never really seen that in recent years, which just means that the Fed has not mattered for markets at all this year. We could argue that there's been better liquidity, but that I think there is a debate is if the Fed has to be more hawkish, for example, because of better growth, will markets even really care?
That's really interesting. A nice perspective there. Does the market really care, even in the face of a pivot? Considering, of course, the valuations, and you just mentioned that, those historic highs, how sustainable is the market's dependence on further multiple expansion in absence of substantial earnings growth? I mean, we all look at NVIDIA as a clear story of this, and some will point that it's times 100 times. But I mean, really, it's historic highs on these valuations, but there's some earnings growth there. What are you seeing?
Yeah, it's interesting because there are pockets of the market, pockets of the Magnificent Seven trading at lower valuations today, even though their stock prices are much higher than they were trading back in 2021, for example. And part of that has been driven by the extraordinary earnings growth. The Magnificent Seven grew earnings by, on average, 160%. Now, a lot of that is Amazon and a lot of that is NVIDIA. So you have some names like Apple and Tesla which didn't have extraordinary earnings growth this year. But it is important to note that that Mag 7 cohort in many ways justified or earned their outperformance. Maybe less for names like Apple, which didn't have strong earnings growth, hasn't seen a big inflection, but has seen a lot of multiple expansion. So when I look at the market overall, what I see is an environment where 2023 was all about multiple expansion. You saw, I mentioned the growth stocks are up over 40% on average in their multiples. If you look for the S&P, it's up over 20%, much less for the equal weight index, which just means the average stock has only seen its multiple go up by about 8%. So there's likely room for some names to re-rate. We're looking at names that have been really beaten up in some sectors that are trading at valuations that are very depressed. Now, the risk, of course, there is that these are value traps and what is cheap stays cheap, but there are pockets of opportunity. I think the challenge as we go into next year, and you asked about the sustainability of multiples, is that if you look at a lot of the biggest bull case scenarios, they're effectively saying we can get more multiple expansion. And, you know, the thing that 2023, you know, has taught everybody is never say never. Sure, like you could maybe make an argument that you'll get back to 2020 and 2021 type of multiples, meaning that you could trade above 20 times forward earnings. The challenge is that this is a very different environment than 2020 and 2021. 2020, you had very depressed earnings. So you put a big multiple in depressed earnings. Earnings then grew 50% in 2021. So you were rewarded for putting a big multiple on those earnings. But you also had huge, huge Fed support. I mean, the Fed was growing its balance sheet by over $5 trillion. Real interest rates were negative 1.5%, 2%. They had cut rates to zero. They were the largest share, were like the 8th largest shareholder in HYG, for gosh sakes, right? So there was so much stimulus from a monetary standpoint, so much liquidity that really did support valuations for a time being very elevated. So it's not our base case that we can return to those 2020 and 2021 type valuations, except for if we go back into some kind of bubble. And what I mean by bubble is that the only other time that you had valuations above 20 times on a forward basis sustained was in the late 90s. And of course, the late 90s, we had a tech story, and you had all, this rising earnings growth that actually decelerated into the end of the 90s. And so it was really based on just multiple expansion. And that multiple expansion was fueled by a Fed pivot. 1998, Greenspan pivots because of LTCM, because of the Russia debt default, because of the Asian currency crisis. And that's considered to have sparked the final stages of the tech bubble. So, for all this concern and worry that Powell is going to be Arthur Burns, meaning from the 70s, and kind of stoking inflation, maybe they should be concerned, and maybe it's not a concern. We could have this debate about it, that maybe Powell doesn't want to be Greenspan, pivoting into a stronger economy in a buoyant market and sparking what could be a big melt up rally.
All vital points there. Let's get into sector and investment strategies. Do you see any as potentially maybe overlooked here, but offering strong growth potential in the current market climate?
Yeah, I think it's going to be another year of pain trades. I think 2023 was all about pain, as was 2022, right? 2022, we started the year and everybody was long tech because it was stay at home and it was the best businesses and they were pseudo monopolies. And then of course they got walloped in 2022, but then nobody wanted to own tech. And so of course they did great in 2023. And so I do wonder if, the most consensus parts of the market are the areas, or the most crowded parts of the market, that despite being great companies, great stocks, that you could see rotations, and fairly violent rotations in a short period of time. I would bring up early 2016 as a great case study of what can happen when markets move quickly. You had a period of just over 2 weeks where almost the entirety of the year's outperformance of value and cyclicals was made up over growth after they had underperformed through 2015. And it happened in a blink of an eye. And then they went sideways for the rest of the year. So don't be surprised if you see violent rotations and positioning rotations. Look at what's happened with small caps recently, right? You had a huge rotation into small caps on a short. It looks short covering because it looks like it's losing some steam, but positioning so light that these things can move really quickly and catch a lot of people flat-footed. So we're long-term investors. We're sticking with our quality bias. We think it still is going to be, it'll still work in 2024. It worked really well in 2023, even through, what has been a strong bull market. Our quality bias, has led us to outperform our underlying indices because we're looking at companies with great balance sheets and good return on invested capital and good free cash flow. And those companies tend to do well in periods of economic uncertainty. And I would argue that we're still in a period of economic uncertainty. Soft landings don't last forever. Maybe we go into a period of people calling it the roaring 20s. I don't like the term. However, that's your most bullish scenario, and that's where at this point you'd want to buy junk. But I think that sticking with quality, sticking with that long-term focus on kind of across sectors is where we want to continue to be positioned next year.
I think this leads, of course, to the loud predictions of 2024 recessions. A lot of people out there talking about it, and now it seems like there's a little bit of a mix. Some people are saying that there might be a milder economic downturn. What do you think about these differentiating analyst views? Are they missing the mark here, or do they hold substance for their revised forecast?
I think the most challenging thing about this very moment is that you can make a very rational argument either way. And this is what was so confounding and challenging about 2023. It's funny, the nuance of our view to start the year was that you're not going to have a recession as early as expected. That would cause the Fed to be tighter than expected, which would keep a downward pressure on valuations and keep equity returns muted in 2023. That last part of downward pressure on valuations, of course, was wildly wrong, meaning that the Fed, as we talked earlier, didn't matter for valuations. You still saw a ton of multiple expansion. And so, we continue to not see evidence yet of an imminent recession. But there are things to point to that should give people pause. I think one of the most important ones comes from Torsten Slok over at Apollo. And he talks about how, delinquency rates are up. They're up a lot over a shorter period of time. You zoom out, they don't look all too nefarious. They're still just back at 2019 levels, and talking about things for like autos and credit cards. But his point is, and it's really good and nuanced, which is that, delinquency rates are up, but look how strong the job market is. So imagine if the job market were to actually weaken, what would consumer balance sheets look like then if people lose their jobs? And I think that point is that, the more we get confident and hyper consensus that no recession is going to happen, the more, and as a whole, the more individual investors should be attuned to the risk. That doesn't mean preparing for doomsday. It just means that we can't get complacent. We still have very high interest rates compared to recent years, which means that companies are going to start refinancing in 2024. We haven't had refinancings a lot in 22 or 23 because you had a big refinancing wave in 20 and 21. So you're going to have a lot of small and medium-sized businesses that are going to have to kind of reassess their business at a higher borrowing rate. A lot of companies termed out their debt, but those companies tend to be large cap companies that have that benefit. So the real refinancing wave comes in 25, but it's a trickle in 24. I would watch that very closely to be a sign that maybe even if the Fed is cutting interest rates, that you start to see some credit stress emerge on balance sheets. It's uncertain, at this point, if that will metastasize into actual employment weakness, which just means we have to follow the data. And the data is going to be, it could be volatile. The last part I'd make is also follow what the market's telling us. The most valuable indicator, one of the most valuable indicators we're watching right now is equal weight discretionary versus staples. This ratio has led revisions of consumer consumption data within GDP, which just means that when this ratio peaked back in early 2022, it peaked right before you started to see consumer spending data get revised lower. But then it bottomed, and in early 23, and it bottomed just as you were starting to see consumer spending expectations rise higher. It made a new year-to-date high this week. So it's not sending a signal yet that run for the hills, the consumer is going to struggle. But when that thing breaks, watch it.
Hey, you heard it first here. Cameron Dawson, of course, definitely smash the like, guys. Let's talk, of course, a little bit of a wrap up here. What potential catalyst, upcoming events will you be watching in 24 that could trigger, of course, rapid market shifts in the dynamic, and just a final outlook for 24?
Yeah, we have an election year, which is always a source of uncertainty, and there's a lot of great work by analysts such as Dan Clifton, who shows how incumbent versus challenger and how that impacts equity performance. So that adds kind of a wild card. I don't want to call it fun, because then it means when I'm watching Jeopardy, I have to watch all these political commercials, which is hardly fun. I think that fiscal deficit, as well as the funding of that deficit, will be very important to watch. The fiscal situation has not been an issue over the last month, but of course it was an issue in September and October. When we get the quarterly refunding announcement at the beginning of 24, do we start to see a bit more volatility reemerge in the bond market as Treasury really has to step up issuance, not of bills, but of bonds? So we're watching that really closely. And then I think as we think going into 24, our base case is that, we're not seeing evidence yet of an imminent recession, but watch out for potholes. watch out for surprise deterioration in data. We've been threading this very fine line of ultra Goldilocks between low inflation, lowering inflation, it's not low yet, and strong growth. And it wouldn't be surprising to see something break in one direction or another. The last one in that is watch energy prices, because energy prices have been the largest source of the decline in headline inflation that we've had this year. And that's partially because energy prices were very high in 2022. So they were tough comps in 22. They've fallen in 2023. So the comps aren't as tough for your energy decline. So if we start seeing energy prices rise on a year-over-year basis, that could have very important implications for things like the dollar, break-evens, yields, and even the pricing of future Fed policy path. So that's an important wild card as we think about what could drive markets in 2024.
Cameron Dawson, CFA, Chief Investment Officer at NewEdge Wealth. All right, team, it's time to keep it going. Let's go to the technical analysis side of things. And like always, as being someone that's studying for the CMT, I think it's always great to bring on the best in technicals. Let's go ahead. Let's bring on Todd Gordon, founder of Inside Edge Capital, founder of tradinganalysis.com. I'll make sure that those links are down below so that you guys can keep following and keep up with Todd. Let's get into it. Let's first talk about the overview of the current market climate, recap some notable trends that define 2023. And it's an incredible year. I mean, for where we came from in 2022, from the kind of that bear market approach to where we are today, This world's different, right?
Oh, it's unbelievable. The year that we've had, it's been clearly led by growth and, growth in terms of the sector rotation. Obviously, we're talking about XLC, comms, tech, and then consumer discretionary, which is one sector and a couple industries that I'd like to talk about with you. But it's been a big move into growth. And as you mentioned, Mitch, again, thanks for having me. As I started out as a young trader, I was a prop trader right out of college. And as I'm getting older, I've been doing it over 20 years now. My time frames are getting larger, right? I'm still trading in and out. I always throw option trades on, but now that I'm running the wealth management business, I'm sort of expanding the time frame larger and larger and adding more, I would say, longer term technicals, observations of what's going on the macro front. And there's a lot of stuff that drives, you're trading in the stock market, but I'm never getting away from my roots as a trader, but so I can bring a lot of different perspectives. So one tool that I've added is the relative rotation graphs, which I find are just an amazing way to truly understand not only sector rotation, but growth and value and watching different market capitalization, small, mid, large, mega, move in and out. That's the key to this market. So long-winded answer to your question. The biggest thing that we saw in 23, I think much to a lot of people's surprise following 21 and 22, with the big spike in interest rates, 4-decade high inflation, was a huge rotation into growth. And one of the charts I'm looking at here on the monthly rotation, I'm looking at two simple ETFs. We're looking at mega cap growth, Vanguard's mega cap growth MGK, and their mega cap value MGV. Now, as these rotation graphs, and this was invented by Julius de Kempenaar, and these are based on Optima charts. As you're moving sort of in a clockwise fashion, you're picking up both relative strength on the horizontal axis and relative momentum on the vertical axis to the benchmark, which is the S&P. The Vanguard mega cap growth moved into the leading quadrant back in August. And I can't help but think 23 was so riddled with so much bearishness. Unfortunately, people were left on the wrong side of the trade. Shorts are getting run over, and then poor people who are underinvested and sort of being scared out of the portfolios are now having to chase. But there's a lot of bearishness out there, I think, remaining. And I think it's important to look at a technical perspective of the rotation on this monthly. And what I did here is how long, when the mega cap growth, large cap growth rotates into monthly leading, how long does the growth trade lead the value? And this was shocking to me when I found this. So I have about 5 or 6 examples of when that happened, when mega cap growth, big cap growth moved into leading. The averages are in green, 58 months, 30 months, 57 months. Now, when growth goes out and value comes into the leading position, how long does that last? That's in red, 9, 11, 16 months. So there's two things here. Like when growth goes in, mega cap growth goes in, it stays there for the last 3 times between 30 and 58 months. And we just went in August. Now here it is December. So 4 months in. So we could have a long ways to go based on past price action in this growth trade. And I'm very bullish on what's happening in this new sort of exponential age. It's like, look what's going on in semiconductors. So super long answer. And I am not, Mitch, I am not a mandated long money manager. Dude, I could close everything in an hour and be short.
And I love this rotation talk, because truly where I've ever found the edge is trying to understand this right here. Because if you can understand this, I feel like you know exactly where big money's going. And that's really where I feel like there's true edge still left in the market. That's the hard part.
And unfortunately, and I have a lot of dear friends at CNBC. I just talked to them on the phone. We got plans for next year. But unfortunately, a lot of times the headlines you see, and I'm not blaming, it's all media outlets, it's social, it's traditional. Many times the headlines you see being reported in the news, both traditional and social, are a little bit different than what you actually seeing in terms of the rotation, specifically on the RRGs. You've got to find that discrepancy, and that discrepancy, that void is what creates edge to trade.
The most important things I feel like is trying to find where the money's going, right? Rotation. We were talking a little bit about that. Now we're looking at identifying potential sectors for strong performance next year. Where do you see those opportunities emerging?
Yeah. So as we talked about in the last question, I do believe that the growth trade is firmly in the lead. We're seeing a little bit of rotation out in the Mag 7 right now, but I think growth is still in the lead. And I think the one catch-up trade to the growth is consumer discretionary. So we're looking at the monthly rotation here of your 11 sectors that make up the American economy. And in the top right is our tech and communications. So we know what comms have done with Google and Meta and Netflix. And we obviously know what tech has done. Amazing. Apple's at highs, and we know what's going on with the semis. So the one holdout, I think, is consumer discretionary. And consumer discretionary is a really vast sector with a lot of sub-industry groups, right? It's got everything from like hotels and autos to consumer electronics and home builders. Like, it's very vast. So you have to break it down and get into the industry and sub-industry group level to see if you can pull this piece together to say, will XLY, consumer discretionary, catch up, move into monthly leading, and kind of give that growth trade the trifecta that we need. And I think the two industries and sub-industry groups you want to look at, I think, are broadline and specialty retail. I think one of the big reasons that we're seeing a rotation right now within Amazon, let's look there, is obviously the products that are being produced by these guys, which are the semis. So I think retail's adoption of AI, like there's a lot of use cases for AI for the retail. I mean, target marketing, inventory management. There's also logistical warehouse management. There's so many different ways that AI can help the retail stocks operate more efficiently, improve their margins, increase top line revenues. Like you look at Lulu breaking out. Lulu looks great. I mean, even look at the gambling stocks like DraftKings. I hold that guy. I mean, there is a lot of different use cases for AI that's just going to increase the margins, and that's going to justify the higher valuation that I think a lot of traditional fundamental analysts are struggling with. Companies are going to be able to, they're going to be able to operate leaner and meaner. I mean, cashiers, unfortunately, cashiers are not needed in this day and age, and you're going to save on headcount there. But there's a lot of different ways that AI is going to help, and Microsoft's a big one that is hitting consumer discretionary as well as a bunch of other industries and sectors as well.
Love this conversation, because normally, what we're seeing in the media right now is about a slowing consumer, that the slowdown is coming. But then you look at this and you could say that it could be going into leading. Well, maybe we might be seeing the opposite of what's being told in the media starting to show up.
And again, I'm not bashing the media. It's what people want to talk about.
It's the normal. It's
the
normal.
normal. I mean, but they told us all year we're going into a housing crisis. And if I brought up XHB, I mean, look at Pulte, Lennar, Toll Brothers, MI Homes. I mean, wait, what? I mean, talk about companies that are efficiently managing inventories, managing their margins. Like, these companies are printing money. I mean, home prices have come off a little bit, but this is a big, transition in the conversation over to interest rates. And that's really what has driven 21, 22, and very much so 23 rates. But, they were telling us we're in a housing crisis, and home builders are ripping on the top side.
Yeah, and just to add to the conversation of what you were saying, how retailers could be using AI, I mean, the number one thing that I saw in the recent quarter earnings calls is mentions of lower inventory. How they're probably getting to that lower inventory, I would think it's because AI usage. And they're realizing how much they can go ahead and maybe push the limits of that inventory turnover so they don't have to have that high.
100%. And we know supply chains are easing up, right? We know, so they don't have to stockpile or, backpile a bunch of inventory. They know it's available and they can more efficiently manage, as you just said. So companies are operating certainly more efficiently.
Let's talk, of course, it seems like the current market conditions warrant declaration of a new bull run. And I think that we can pretty much base it on technical grounds, but is this the new bull market, Todd? Or is this, you feel like it's here to stay?
Well, here to stay is a big, that's a big proclamation, but yes, I am bullish. I think as we talked, the Nasdaq's 2% from all-time highs. Like just step back and think about that for a second. Like, wait, what?
Keep it simple, right?
Wait, what? I mean, what? I mean, it's amazing. Like, okay, and semis are moving. We talked about that. Software stocks. This is really cool. I'm looking at. We just got the new Q3 money market fund data. So in Q2, this is the orange line right here. I think it was about 5.9 trillion. Oh, right here, 5.91 trillion in cash in the sidelines. The Q3 data just came out. It popped up to 6.14 trillion. So that's what the market, this was obviously in Q3. So there is so much money in money markets, and it increased in Q3. This money is in there collecting your 4 or 5% yield, where inflation's resting at 3%. So your net return is 2%. This money is going to have to be redeployed when markets realize, okay, and effectively making a real return of 1 or 2%. So I think I definitely think we're in a bull market. Commercial deposits dropped, which no surprise with the regional banking crises that we had. So money's in there. And then technically speaking, like I just updated for our wealth management clients and our research clients, our target for, it was H1 of 24 on a technical basis. I'm a wave and fib guy. I've been doing it forever. I can't get away from it. I love it. It's, a lot of people don't really understand or want to understand that there is no certainty, and all analysis, whether it's fundamental or technical, it's all subjective, right? But this is the way I sort of give myself the guidelines and boundaries as to where I think the market is going to exist. So our H1 of 24, which I just bumped up to Q1 of 24 target in the S&P, is 48.50. So the old highs are 48.22. It's a really nice 5-wave move from the late 22 lows. We're going to have to deal, I think, with a big old cluster of resistance around 48 to 4,900. That could be right after Q1, and maybe it's a sell in May and go away. That we then correct. And then I think into the end of next year, we could be setting up for a wave 3, and this could be a rip-roaring rally. And again, I am not a cheerleading long-only bull. I love trading high vol drops in markets. I put hedges on. We do option hedges. Like, I'm not a long-only rah-rah, but I have a feeling this market is setting up for a ridiculous rip next year once we get through that wave 2 correction.
Yeah, and with of course, we don't know what's going to happen in the political landscape, but that could definitely play into that. We'll definitely keep the watch on that. I love how you also draw your lines, and you can see them there, guys. They're not just straight lines, right? The truth is the markets don't go in straight lines, man. They're a little bit curvy, and
especially the indexes.
yeah. And I like how you draw them up there, because the truth is that this is what it gives us. This is what technical analysis, I feel, is the best use of it, is scenario analysis. Because the truth is there's nothing that's 100%, but we need to be ready for both scenarios.
100%, Mitch. You have to have plan A and plan B. And if you have a plan, you need to act on that plan and act with conviction, provided you followed your process, but always be looking over both shoulders. And when the facts suggest, there's never a time where the facts change. Let's get, when things start to look and challenge your thesis, okay, maybe we need to adapt and go to plan B. There's no way to foretell the future. Your job as a trader investor, who has a plan, assess the now thoroughly, act on that plan. And then, as I said, look over both shoulders and adjust as things start to look uncertain based on your plan.
Of course, moving beyond the mainstream attention, can you highlight a stock, industry, or maybe even just a sector that might be underrated by retail investors and that could actually have good potential and maybe majority are overlooking?
Yeah, I think the one that we're seeing, we're actually getting ready to do our sector industry report tonight. We're seeing a pretty good rotation right now. This is over the next month or two in financials. And it's not so much insurance, because insurance, reinsurance has been leading and keeping financials afloat for most of 23, but you're seeing a rotation now in asset managers, diversified banks. You're seeing in the investment banks. So financials, and especially the lower market capitalization, call it, 25 to 100 to 150 billion market caps, maybe not to 100 billion, but sub 100 billion, call it. You're seeing a pretty good rotation, and even some of the regionals are starting to show some signs of strength. And again, we have visibility on where short-term rates are with the Fed. We know where the yield curve is. We could talk a whole bunch of that, and financials rotating in, as well as real estate, XLRE, and some of the REITs. Man, when the Fed, when the 10-year rate topped out at like 5.0, 5.05, 5.1, like last month. I don't know if you watched, but real estate and the home builders were literally gapping up. XLRE, real estate REITs, home builders were gapping. They were crashing higher. So it's real estate and financials in the near term. And I think, the big leader in technology that has allowed that growth trade to rotate in back in August has been semis. There's two groups, and I already mentioned them within technology. It's systems software, application software. A couple names that I'm very heavily focused on. And I think these guys, these software companies, which of course are going to be beneficiaries of AI and high power chips, Manhattan Associates, ServiceNow, Cadence, CDNS, Synopsys, NSPS. Those are some names that we're watching. So watch the software stocks within tech. They could become, those are high margin businesses, obviously. Those could become maybe on pace with driving the technology sector forward.
Love to hear it, and definitely different outlook there. You guys see it. Sector rotation, definitely important to follow. If you guys don't know who Todd is already and you're just tuning in, definitely check out, of course, tradinganalysis.com. They put out some great content, and a lot of it's right there on YouTube for you guys to tune in. So if you guys haven't done so already, definitely check it out. I know I tune in all the time, and the big part of it, to catch with that sector rotation, right? Because a lot of times I'm doing this analysis, but if I can go with some others and see that quantitative approach, see that it's kind of matching that could really give me a little bit more conviction that maybe I'm seeing the rotation, that same thing Todd's seeing, same thing that some other experts are seeing. And I think that this is the important part. We don't have any strategy, I think, in all of finance. It's 100%. But one thing's for certain. If we could go where the puck is going, I think we'll be able to see some return. Right, Todd?
It's a big one. That's really, really well said, Mitch. Do we have time to hit some? Do you want to hit interest rate stuff?
Let's do it. Let's do it. What you got for me?
All right. I'm having so much fun with you. Sorry to keep you around so long.
No, let's do it. Let's keep it going here, guys. Smash the like. Let's go.
There we go. Yeah. Especially for Money Mitch. So, I think the big one that's been driving is the volatility, not just in 23, but over the last 2 years is level of interest rates and the yield curve. And I mentioned it earlier is you can't just look at the nominal yield curve. You can't look at a mortgage, it's 7.5% mortgage, but your payments being inflated away by 3.5%. Your net cost on that mortgage payment is actually 3.5% because your same payments are getting cheaper as inflation's here. So you got to look at the real rates. So the big story was yield curve inversion. It's something that has kept me up for many nights thinking about it, hearing the debate. And we are certainly still inverted on the 10-2 yield curve. Right now, we're about 52 basis points of inversion. But if you look at the real yield curve, in expected inflation 10 years out, this is published by St. Louis Fed, and expected inflation 2 years out, you get a slightly different yield curve. And you could see that we actually came very close to coming out of inversion on the real yield curve. And there's a lot of debate out there. And this is interesting. People are saying, well, and I think this is the biggest mistake that was made in 23 is sort of this recency bias, or just looking at the last two examples of what the market did when we were in yield curve inversion and what the stock market did. So I did this study for wealth management customers. I'm like, okay, let's go back and look at what is the market return when two things happened. When the real yield curve was inverted and it came out of inversion. I've heard a lot of commentary that you want to sell stocks because the last two significant examples were 2000 and 2008. Well, if you look at all of the examples, and I labeled them here, if you look at all the times the yield curve was negative, went positive, I looked at the 1 year average return in the S&P, the 2 year average return, it's 13.9 and 22.3%. So if the real yield curve can push out of inversion, that spells, using 50 years of data going back here, I think I was going back to 1980 for positive returns in the market. Okay. And the big thing we got to look at, we know where the Fed is. Everyone's talking about the Fed cutting next year. Well, I don't think we need to. I mean, they're going back and forth. Are we going to cut 5 times or 4 times? I don't think we need to. I think the Fed should leave the rate right where it is. If earnings and GDP growth continue to be where they are, let's leave it. I think the market, the economy's shown a lot of resiliency, and let's cut it when we need to. The big one for me right now, the big focus is, I hope on a macro point of view, because equity market has been so driven by macro forces, specifically long end of the yield curve by 10s and 30s and the short end by the Fed. If this yield, which here's the one thing people need to watch, if this 10-year yield keeps dropping, breaking the March of 23 high of 4.09, I'm worried it's going to send the wrong message to the market that bonds are coming back in the name of risk aversion, a coming recession, and we're going to have to go through this again, which people are like, oh, okay, we're coming to recession, sell stocks. I don't want to see these 10-year yields drop any lower. If we can hold, ideal situation is we hold between 4.1 and 4.6. And then we are going to just, until the Fed cuts once or twice, we're going to deal with the 50 points of inversion between the two. I think that's fine for now. I just don't want to see rates move lower. And I'm not telling you I know what's going to happen, but Mitch, your earlier point, watch what and how the market responds, because they think they want lower yields on the long end, but I'm telling you they don't. It'll help from a US dollar perspective, but if 10-year yields drop, it may send the wrong message, and we'll have to watch how the market responds to it. This is such a key driver over the last year. It may continue to be next year. Hopefully it just goes into a range and we can stop being such macro economists.
Love to have it. Like always, guys, if you guys don't know Todd, definitely give him a nice follow. He's one of my favorite follows, keeping up with so many different areas in the market. He brings different variables. You can clearly see it with interest rate talk here, bringing in the tradinganalysis.com action. If you guys don't check them out already, definitely give them a look and keep up with them into 24. Because I know Todd's going to be on top of things, continuing to grow. So it was great to have you on in 2023, Todd. I'm looking forward to seeing what you can do next year. and we'll all try to keep up with you and see what we can find in this market, because it's not going to be easy. And there's always that conflicting noise mix between, I think, the media, what we're actually seeing, what we should be looking forward to, because at the end of the day, a lot of times when you're reading the articles, that's what's happened already, not necessarily what's coming.
And that's what we love about this game. That's why this is your profession. Like every day, and it's so much fun. I can't wait to see what happens next year. And it's awesome, Mitch. So, hey, man, thanks so much for the kind words. You're doing a great job. Appreciate it. And everyone listening, I hope you guys have a great, great new year. Happy, healthy, prosperous, and all the best.
All right, traders, who's ready to get back to it? Of course, I have none other to give us the technical analysis after Jerome's big rip, none other than Jay Woods, CMT, Chief Global Strategist at Freedom Capital Markets. It's good to have you back on, Jay. How are we doing?
Mitch, we're doing great. I mean, if you're a bull, then you're loving it because you're seeing the market, the Dow Jones at all-time highs, the S&P knocking on the door. Now we need the NASDAQ composite, the Russell, to join the party. But it's been one of the more unpredictable years, unless you were following the technicals. And it was a pretty basic year in a year 3 presidential cycle. And it played right to all seasonal factors. And I love the setup we're seeing at the end of this year as we head into 2024.
Yeah, I know that there was a lot of bears out there thinking that Santa was bringing coal this year, but it looks like not everybody's on that naughty list this time. Definitely a nice rally going into Santa Claus.
Yeah, Jerome Powell kind of surprised most of us down here at the stock exchange yesterday. We didn't expect a pivot. Everyone expected no rate cut, no rate hike, just stay the course, stay neutral, and then his usual speech. Well, his usual speech got a hell of a lot dovish, a lot more dovish than we expected, and the market loved it. And what are we doing? We are now going full circle in the S&P 500 to the highs that we saw on the first trading day of the year. Back on January 4th of 2004, when the S&P 500 intraday went as high as 48.18, closed at 47.96. And if anyone was smart enough to go out the first trading day of the year back in 2022 and say, yeah, we've hit the highs are in for the year, they were a genius. And the whole year was just a slow, consistent, steady sell-off. It was the end of the world. Recession was imminent last year at this time. I think there was 100% certainty we'd hit a recession. Well, how'd that work out? And then what happened? Rates continued to climb. What made new all-time highs? Home builders with mortgage rates at 8%. Regional bank prices early March seemed like the end of the world. We shook that off. We raised rates until June. And then we had, I think, one more hike after that. We've gone 3 cycles without a hike. And now we've got right back to all-time highs where we were at the end of 2021, beginning of 2022. And that full roundabout, that full circle puts us at a very interesting setup for 2024, and I can't wait to see what happens next.
Yeah, I mean, it's not the prettiest, but it's kind of like a huge cup and handle here.
You think?
I mean, you think? I mean,
Can you draw that little rounded bottom with the
little man? I mean,
now breakout.
It's not always as pretty, right? This one's a little bit more V-shaped, but I mean, this is pretty move, right? I think that that retracement that we just had into November, put the fear back into some bulls, but that gave an opportunity, right? I feel like that was the opportunity, especially if you were on the sideline when we ran up to that 460 to finally join the party, right? And
what's interesting, did people finally join the party? There were a lot of bears out there, a lot of people on the sideline waiting for a pullback like that. And then when you get it, you get the fear. And listen, I've been a bull this whole year. I had that white towel in my hand when we had that pullback. 4,200 was not only a line in the sand because it was old resistance, which should have been support. It was the 200-day moving average, a rising moving average, and a Fibonacci retracement level from that October 13th, 2022 low to the recent highs. And we got below there for a little while, and we kind of accelerated. We spent 6 closing days under the 200-day moving average. Ironically, we spent 6 closing days under the 200-day moving average in March during the regional banking crisis. And that fear came in, but we had a rally and it was furious. From false moves come fast moves in the opposite direction. We had that false breakout. Toughest thing for any technician to call. This is a bear trap, your classic bear trap. You don't know it until hindsight. Let's be real. But once it reclaimed that 4,200 level, we were off to the races and people were scrambling. The shorts had to cover. Then you put in seasonal factors. November, second strongest month of the year behind April. December, third strongest month. So you had that Q4 rally that we were anticipating. You add in the third year of the presidential cycle, and everything played true to form. What were the two worst months of the year? What are they historically? They are September. They are October, where more bottoms are formed. It's actually August and September, two worst, but more bottoms are formed in October. When I say bottoms, I mean 5% retracements and then a reversal. We got that reversal. It was a 10% correction. And guess what? 10% corrections happen on average every 18 months. And that's what we got. We got a normal year, 3 5% retracements, 1 10% retracement. And now we're knocking on the door of all-time highs in the SPY. We got them in the Dow. And now watch the broadening effect. Watch the Russell, which is knocking on 2,000. I think we're above it as I speak to you. That's a major breakout of a nice intermediate trend. Let's see if we can close above there for 3 days before we confirm that. And then what's next? 52-week highs, all-time highs. Those are 10% higher than current levels. And that is showing the broadening out, the strength of this market. And I think that strength is no longer the Magnificent Seven. That was the narrative for most of this year. Some of those stocks will continue to do well, but they're not going to lift the market and hold it up on its shoulders by itself anymore. The broadening out should continue, and the way we're ending this year is a good start to the new year. Will it be smooth sailing? No, it won't be. But this year was the first year of this new secular bull market that we're in that started on the October lows in 2022. The second year in a secular bull market should be slow, steady, and boring. The VIX is going to be kind of doing nowhere, chopping sideways. We last saw that, I believe, in 2017, where it was just a slow, steady uptrend. Not a lot of good headlines. We'll have good headlines this year if you follow politics, but politics don't always, actually lead the market. It causes intraday pockets of volatility, but we've had, since I've been at the New York Stock Exchange since 92, we've had 3 presidential impeachments, and I thought, oh my God, the market's going to react to this. It didn't. But we will see some cycles. But I think the earnings recession that we've already gone through, that is past us, and earnings are starting to project higher. And next year will be, a lot more sectors participating, and the strongest in those sectors will lead us. And we can get into some of those names if you want in a little bit.
Yeah, let's talk a little bit about, of course, identifying potential sectors that are poised for strong performance. One of the things that I think is always important at this year is investors looking at that, right? Like the top 3 sectors, what performed this year, what was on the bottom, right? What didn't perform. Will maybe one of those 3 that didn't perform maybe be the top performer next year? Of course, last year, technology was actually near the bottom there, and we saw how that worked out. So what are you seeing out there for potential sectors poised for that strong performance?
I think the strong will continue to lead. So I do like technology. I do like communications. When you look at technology, the 3 biggest stocks in that index, you're looking at Microsoft, Apple, and NVIDIA. I continue to see strength in those names. I don't think you're going to get the 220% gain that you saw in NVIDIA. But I went back and I looked at NVIDIA and I looked at Amazon. I looked at all these stocks and I'm like, how have they performed after ridiculous years, 50% or more growth? And more often than not, they continue to keep that momentum going. And when you look at NVIDIA, we've been in a neutral trend in NVIDIA for about 5-6 months. That 500 level is that line in the sand. It's clear resistance. If we can get 3 days above 500, 3 closing days, it can go much higher. And NVIDIA has performed well from a fundamental point of view. They've beaten earnings. Their projections have been fantastic. Yes, there are some concerns on the China front, but they are positioning themselves to pivot away from that if it does become a headwind. And the stock, what did it do on its way down this time? It never went back to its old lows. I mean, it could still fail at 500 and then create new lows, but I think the strength is there. I think it will lead again, but a 200% rally, come on, let's be realistic. But you can get 25, 30% if it breaks out over 500, and you can see the stock go to 550, 600, and relatively quickly. It's a name I like, and thank you. You're pivoted right to where, and what does it lead? It leads to semis, and the semis are just breaking out. NVIDIA was by far the shining star, and then you have Broadcom, symbol AVGO. That stock just broke out a few days ago. That stock and NVIDIA did something that we're seeing the broad index do now. They made back their 2022 losses. NVIDIA was down 50% in 2022. For it to go up and make those losses back, it had to go up 100%. Well, it did that, and then it went up another 100%. We're seeing the leaders within the space continue to lead, and technically, they made the full circle. So what I look for in the space are who are the stocks that have done well in the tech space that haven't made that full roundabout or on the verge of doing that. And what I look for, at least in the semi space, look at a stock like Lam Research. That never even had to make a LRCX as a symbol on Lam.
Gotcha.
That has withstood a lot of it, but full roundabout and just breaking out now has room to run, can follow in the steps of its brothers in NVIDIA and Broadcom. And here's one, old tech, Intel, INTC. Oh my God. Phenomenal year. Turnaround is there, but no.
Is Intel sexy again, man?
Listen, you're not going to get the move you got in a NVIDIA. It's not going to run away, but I think the stage is set for slow, steady uptrend. Just to get back to those old highs, you have a nice 15, 20% gain. And then if it breaks out, the fundamental story is NVIDIA is talking with Intel. And if there's a pivot from China, Intel is going to help them there. And if that does happen, you've got a good story. It's still in the Dow. So the index lovers will love it. It pays a nice dividend. And it has a lot to reverse. So I think Intel could be a good play when you're looking at that space. And then when we're talking tech, cybersecurity continues to be a strong theme. So I look at the Hack ETF, which, covers some of my favorite names. CrowdStrike. Yeah, look, we're not even full roundabout there. Look at CRWD, CrowdStrike. That is a stock that still has yet to get back to its 2022, late 2021 highs. It's breaking some major levels here. Now, these stocks have gone parabolic over the last few weeks. There's no reason they shouldn't pull back. I mean, you don't go in a straight line forever, but these pullbacks to me are opportunities to add to the name, to get into the name. And that old resistance level, which I can't see on my small screen, but you can point to under the declining 50-week or 50-day moving average you have there, that we just broke above. There you go. There's a great level to enter if it does pull back that dramatically. That would be something else.
Yeah, this is the 50 exponential moving average that I have on the screen here.
Exactly. But a fair target over a year's time would be 300. And percentage-wise, what are we talking? That's 20%. If my math off the top of my head is good. And then you have other great names in the sector.
Pretty good, 19. But not too bad.
I was off by one. And then
you
look
pass.
At Palo Alto Networks, best in class in the cyberspace.
Best in class for sure, without a doubt.
And then my favorite pick, and when you know it's my favorite, it means I told my mother or my father to buy the stock, is Cloudflare, symbol NET. Talk about stocks that have nice bases and are just starting to break back out and have a hell of a lot to reverse. Now, we went parabolic at the end of 2021, probably a little irrational exuberance there. But, a nice 20, 25% gain from these levels, I think is a very safe call to make. And then let's put bear cases in there. From a technician point of view, you have areas where you want to set your stop, because when you're buying these stocks for the first time, you don't want to say, oh, well, Jay said it's going up 25%. Yeah, well, something can change and price will lead that change for me. And if it breaks back down below that old floor where it, old resistance becomes support, then you put a stop in and you limit your loss and you reevaluate the trade. But right now, the risk reward setups are very favorable over a 1-year time horizon, that these are great names to be in and great names to add to on a pullback, given the recent runs, that I think that this part of the technology sector is going to lead. And then there are other sectors that I think are poised to move. And like I said, in October, that was gut wrenching because I said 4,200 would hold, and I had that towel in my hand, and unlike Apollo Creed, I survived by not throwing in the towel, and I survived that Drago sell-off that we were withstanding in October, and we did move on to new highs. So I got lucky that the technicals held, even though they were teetering on making me look like a fool and pivoting. So you always have to remain nimble, and for the trading audience, whenever you get into a stock, the first thing you do is think of your risk. Because
Always.
if you don't know your downside risk and don't have an exit strategy, and you're using double up mentality, and it becomes gambler talk, then you're not going to be in the industry as long as luckily I have been. For 31 years. Jesus, oh man, I'm old. 31 years down here, and it's exciting. I love year-end reviews, and I was blessed that this year was good to me. And we made some good calls. Not all of them worked well, but the general direction was bullish. I stayed true to that, and I think it will be bullish, but not as euphoric as what we had this year. I wasn't that euphoric about this year. I thought it would take us another 6 months to get back. And Jay Powell has just put it out there on a silver platter, and kudos to him. The thing that scares me, to be honest, Mitch, is now too many people are in that soft landing camp. Where were we a year ago? Everyone was in the recession camp. Well, what happened to that recession? You want to talk macro, watch the unemployment numbers. When you study macro, 2 negative quarters of GDP means recession. Well, we had that 18 months ago, 2 years ago at this point. Guess what? No recession. Inverted yield curve means recession. All right. On average, that's anywhere from like 10 to 18 months after it happens. We're about at 17 months from when the yield curve inverted, I believe. Never got it. And then the last one is the Sam rule. Sam was a Fed governor, and she had stated, and her rule has been in effect. And it's pretty much what I think the NBER, the National Bureau of Economic Research, uses. And they're the ones that officially call recession. When you hit the peak unemployment or peak employment, I guess, that was back in June at 3.4%. Once you rally a half a percentage off of those lows on a 3-month rolling average, so a half percentage higher would be 3.9% unemployment. We got there last month, November. December, we went down to 3.8, or October 3.9, November 3.8. It came out in December. Let's see where we are in December. If we stay at 3.8, 3.9, go to 4. Once we hit that 3-month average of 3.9%, then it's inevitable, according to this rule, just like 2 negative quarters of GDP was inevitable, inverted yield curve was inevitable, that a recession could happen. And the one thing that was holding back the NBER from calling an official recession was the unemployment rate remained at historic lows. We go to 4.2%. We're still at historic lows, but they may call for a recession, and that may catch us all off guard. But guess what? Each time is a little different, and this time is very different. We had extremes because of COVID. We had extreme moves in the Fed, the highest rate cycle we've ever seen. Mortgage rates, the highest they've ever climbed, the fastest they've ever climbed, not the highest. But every time is a little different, and there could be recession talk back on the table in 2 months. And what happens during a recession? The market sells off. And what does it do? Since 1950, this is a Tony Dwyer Canaccord stat that I love. It makes a new low. And for us to make a new low at this point, given recession, I call BS on that. I cannot see a recessionary call based on unemployment rising, even though it's at historically low levels, causing us to go back to that October 13th low of 2022, which was, where were we? 3,700. Should know that. I should know that off the top of my head. But for the S&P to fall that much because we have officially been dubbed the recession, that's silly, because guess what? When you get the official recessionary call, they backdate it. And when they backdate it, that means you're already halfway out of it. I think that could be a nice buying opportunity. So, I don't see us retesting those lows in this cycle if they call a recession. I really think we're set up to be slow and steady. And if they do give a recessionary call, now finally they're going to look back and be like, yeah, we probably should have called that a long time ago, but unemployment never jived. So they're waiting for that number. That'll be the interesting thing. That'll be the one thing that derails the slow and steady market. I don't think a recession is off the table based on unemployment, but overall, I think we had earnings recessions. We had different rolling recessions, whether you're looking at egg prices that went ridiculous, lumber prices that went ridiculous,
the olive oil.
Yeah, I forgot about olive oil. That was a good one. And then we had gas prices. I mean, my gosh. So there have been pockets of pain throughout. So now we may see it in unemployment. I don't know, but I don't think it's going to derail the market that much.
Well, Jay Wood, CMT, Chief Global Strategist, Freedom Capital Markets. Always great to have you. And I wanted to give you a little bit of a shout out because that New York Stock Exchange tour that we did in just right before 2023 has over 41,000 views. So I just wanted to give you the insight on that. It's definitely growing.
There are people that are viewing this to try to get scoop for the next year that haven't seen that. So link that tour. I know you came down with your crew. We had a great time, and I love welcoming people to the New York Stock Exchange. It's been my home since 1992. I'm blessed to come into this building every day. I do not take it for granted. And as you can see in that video, I enjoyed having you guys down here, and I welcome you back anytime.
Awesome, Jay. It's always great to have you, and we'll have you on next time. And have a great 24, my friend. I know
Merry
you kicked
Christmas,
ass in
Happy New Year. Thank you. And, Merry Christmas, Happy New Year to everybody. And let's hope this bull market continues. Take care.
All right, traders, there you have it from none other than, of course, Jay Woods, another CMT. And guess what? I'm going to keep the CMTs rolling here. We got, of course, Martha Stokes, CMT, co-founder and CEO of TechniTrader on next. Let's bring her on. How are we doing today, Martha?
Oh, we're doing great. Thank you very much.
It's always great to, deal with CMTs. Of course, I'm in my studies right now, but I always love learning from the past, the greats, right? I have to put it because I think at the end of the day, in this industry, I think that sometimes people view things as competitions when really we need to be working together, learning from the best, and then us that are younger trying to just gain footing in this space. So how are we doing today, Martha?
We're doing great. It's a good idea to blend what the stock market and the financial markets do very well is that they believe in the brain trust, someone who's been around for a very long time, but there's always innovations, there's always something new happening in the market. There's always something changing. Yeah. So it's very exciting because there's all this new information and new ways of trading and making money in the market that is an ongoing evolution. And that's what I love best about the markets.
And that leads us really to telling us a little bit about TechniTrader, right? Tell us a little bit about your background. I know that you're a CMT, but let us know a little bit more about TechniTrader also.
Okay, Howard Johnson and I co-founded TechniTrader 25 years ago. I had retired early and was very bored. And he says, oh, let's just hold a workshop because lots of people keep asking us. We closed our small funds and sold it. And he said, let's just teach a workshop. And I said, are you crazy? And he took a year to talk me into it. But then when I was standing in front of the room, I realized full of stockbrokers, professionals, and brand new traders that we had something unique to offer. And that is the professional side of the market viewpoint. Retail traders have plenty of access to day trading training and all kinds of things. But when you get down to the nitty gritty and you want to get serious and you want to be a semi-professional making monthly income or professional making those high number incomes that they make, or even working toward becoming a floor trader or a prop desk trader, then you need TechniTrader education. We do have education for beginners, but we also cater to the professional.
I love it because at the end of the day, there's only one way to get to the professional, right? We all got to start as being beginners, right?
Yes.
So, of course, let's talk about the outlook going into 24. What do you see as the most important trends to pay attention to over this next year, Martha?
Well, I think what I do differently than everyone else is I do probability studies. Okay, what are the 135 industries in the U.S. economy? What are those reports telling us? What are they? Because the industry reports are very important. Are corporations, big corporations, at market saturation to market decline of their products and services, or are they reinventing brand new technologies? And how many new technologies are coming to market? How many are R&D? How many are at market introduction, market acceptance? There's a product and cycle and a service cycle that goes, and we have to watch that because the wave of the market, the bull to bear, it follows that closely. Also, we want to say, okay, some people are saying we're going to have another bear because there's an inversion in the bond market. Well, after studying it, because I'm a cycle theorist, we have a very broken inversion. And so that means that that cycle has broken in that barometer. I have 12 barometers I check all the time to see where we're at with growth in the stock market and what's happening. And that one's broken. So that's no longer a factor as far as judging whether a recession is coming or not. For 50 years it was. But once the cycle is broken, it rarely repairs itself with changes. Now, why did the bond market change? Because during the pandemic, it went fully automated on the professional side. It's very fast trading now, and more of the professional traders are using that bond market as an extra leverage or mitigating of a high profile stock. Maybe they have 5 million shares in Microsoft or something, and they're trading it on a swing. So they're using options puts, they're using futures, they're using E-minis, and they're using short-term bonds. And so this creates an anomaly to people who are used to the traditional cycle that doesn't exist anymore.
And if you don't adapt, a lot of times what happens, you die off with it too. And I think that that's the important thing, is catching those trends, like you're saying too, looking into those industry reports, right? I always say, let's not work forward, let's work backwards, right? If we can understand what's going on from the top down approach, that's definitely going to help us continue moving. Now, there has been the battle, of course, between the bull, the bear, and as we head into 24, are we in a bull market? And how do we know that it's not just a good old-fashioned bull trap?
Well, it's not a bull trap. Bull traps happen as the market is trending down. The market has completed a full bear market from 2018 to 2020 March. And then it had a rebound that was accelerated, which was fueled by the stimulus checks. And so it made it a hyper rebound. And then we had an intermediate term correction in 2022. So now we're on the upside of that, and the indexes are testing those highs, those previous highs of 2022. What the fundamentalists are doing, which the market is still based steeply in fundamentals, but if you use technical analysis, you can see where the fundamentals lie in the chart. That's one of the things that professionals do, is they study the charts and they can see where the fundamentals lie based on the buy zones of the dark pools. So we can see that they're raising their buy zones, which means that they're expecting a very strong earnings season. Now, how could they know in advance? Are they predicting it? No. They go out to the places, to all of the different major companies and corporations. They sit down with the CEO, the CFO. They do a walk around. That's what it's called, a walk around. They check out the corporation. They look at the books. And so they know by now what that report's going to be in January report. So they're way ahead of us. So if they're buying and accumulating, then we have a strong bull market, because what's happening is they are projecting out that that's going to be a very good earnings season, because they know, because they've looked at the books.
And one of the things that I always look for is the trends behind the bull market, right? Because if we talk about industries and we talk about technologies, we need to be very apparent to what is driving this next bull market, right? So what technology do you see driving this bull run?
Well, there are 20. In 1990, there were 6. So we have right now, what's driving a lot of activity is hyper automation of the IT departments of the major corporations, the conglomerates and the huge corporations. IT is very expensive. All these separate little PCs and all these things are very, very hard to manage. So hyper automation of the IT department has been going on during the pandemic, started in 2020, because they realized they needed to be more competitive by making the whole system efficient. And there's the distributed ledger technology that has been around for a while that is widely accepted now. That's also called blockchain, but it is distributed ledger technology. There's all kinds of new technologies coming. Of course, the big ones for retail people that know about it are EV, electronic vehicles, and supply chain and things like that. But there are 20 new technologies that I'll be studying. I do a annual market structure report explaining the difference in the structure from one year to the next. And I also do a industry sector and super sector report that takes me quite a while to do so that my students know which industries to focus on and which sectors are going to move strongly. Now, the problem with the current technology is a lot of it is hidden because it is rebuilding the corporate America. And it's from 16 to 19, they were doing buybacks just to keep the market going up and up and up. Well, they weren't putting anything into infrastructure. Now everything's going into infrastructure. That's why you're looking at software infrastructure and all kinds of different technologies, robots, robotics, humanoid robots coming out of Japan. And there's a huge shift going on with all things that are happening. Also, remember that the NASDAQ private market, where the buy-side institutions can now invest in a private company before it goes public, is huge. When those little guys come out of the private market and move as an IPO in, they already have the buy side invested heavily in them. So those are going to really take off and be strong IPOs. So there's a lot of activity going on that points to a stronger bull market. There is very little activity that would imply probability-wise of a bear market returning. We will have intermediate term corrections. We will have short-term corrections. We need a correction right now because we're over-speculated. Price has gone on many of the index components has gone beyond the fundamental level. So we'll correct back to the fundamental level, and then you will have an opportunity to buy again.
Yeah, there's nothing like the exuberance sometimes to drive those fundamentals a little bit away from the understanding and then has a tendency of coming back into play. That's why you got to keep up with multiple variables in the market, right? Sometimes technicals are going to lead. And like I always say, watch out for the story stocks, because when you get those technology behind those story type of names, it can just keep driving. And, you know, everyone can argue about what PE ratio the stock can be trading at. But the truth is that at some point, if the stock is just ripping to the upside, it almost doesn't matter to it at some point.
It was called irrational exuberance in the 90s. And Greenspan coined that phrase, and it will be present here. And there will be times when it really moves with strong momentum because there are more and more millennials investing. There's a larger body of overall Americans investing in the market, and they're coming in. So there's a higher percentage of people. We have $100 trillion under asset management right now. That's a big chunk of change. That's mind-boggling.
And money on the sideline too.
Oh yeah,
waiting to go.
Yeah, the buy-side institutions keep a very large amount of cash reserves so that they don't have to do redemption demands and sell stocks. They just pull cash out and pay those redemptions back when that happens. Yeah.
Of course, you study the markets and the cycles, right? And what can we learn from past bull cycles that we could maybe play into this cycle?
Okay. We can start with the 20th century. The first bull market was right after the pandemic, the Spanish flu pandemic, which lasted about the same length of time as this one, which was a much shorter pandemic than the 1830s to 1848 cholera pandemic, because we traveled and it spread faster. But we also have better medicine and things to tamp it down, and vaccines and so on and so forth. Whether you believe them or not, that's what happened. And so we look at that bull market, and we also saw that prior to the pandemic, electricity was coming around, automobiles were happening, electric mixers, electric toasters, all kinds of things for the household. Industrial revolution was happening. Okay. Yeah. So that was the third industrial revolution. We're in the fourth industrial revolution, and it's based more and more on your high technology based out of computers, robots, humanoid robots, as I said before. Robotics are heavy. There's all kinds of activities that will displace a lot of companies. AI is already widely used in small businesses, medium-sized businesses, big businesses to help their marketing strategies and all kinds of this, so they can eliminate a lot of workers there, which is a good thing because we have more people retiring, and we still have 9 million job openings and a very low unemployment rate. So that's an anomaly unto itself as well. So I see the growth accelerating as it did in the 1920s to 1990s is going to accelerate.
Yeah, you know, some people calling it the roaring 20s. They're coming back, Martha. We're going to go dancing, baby, on the street.
Well, there's a lot of similarities because the bull market of the 20s started out with the banks, the corporations, and the wealthy. And then it got to a certain point where it was struggling. And so the banks said, well, why don't we create this new instrument so the middle class of America can invest? And we're going to call it mutual funds. And they invented mutual funds in the late 20s, around 1927, 28. The market went ballistic. And then, of course, it crashed because it was way overvalued. And the banks were corrupt. They had invested heavily in high leverage things, and banks were collapsing all over the place because of a real estate boom. So that caused that problem.
That's always an interesting one, right, Martha?
Yeah.
Banks being greedy.
Yeah, and mutual funds were banned as evil, and they didn't come back until the mid 50s. Now we have ETFs. We have a similar problem, but
yeah,
the buy side institution always studies the past, and they say we are going to learn from the 20s and we're going to learn from the 90s, and so we're going to be prepared for sudden ETF selling. And we're going to have that. They already proved that they can do it in 2022. They supported the market. It dipped into the 20% bear market range and popped right back up, dipped again, popped right back up, because the buy side institutions did what they call support the market. That's something that they don't talk about, but they did.
I agree. And I think that's something to note, right? Because as sometimes investors, if we don't understand that, then I'll tell you one thing, that whole bear side sometimes doesn't seem as good to me, because if they're always going to be able to step in and kind of save the down action, well, then it really doesn't make sense to be long-term bearish, right? It makes 10 times more sense to be long-term bullish. Let's talk about the best ways that someone could take advantage of this bull run and not be left behind.
Okay. Well, first of all, don't chase runs. If it's out of control, it will retrace and come back down to a legitimate fundamental level. You have to learn technical analysis as well as fundamental analysis. It's just too hard if you don't have technical analysis in your training, and you need that. It doesn't matter whether you're long-term, intermediate term, short-term, swing, day, it doesn't matter. If you can read the charts like you would read a book or read sheet music and see the nuances that are going on behind not just the candlesticks, but actually what is causing what, then you can get in at a good price, and you can hold it long-term, or you can trade it for monthly income. There's all kinds of ways to make money in the market, and there will be more and more opportunities. Non-fungible tokens are coming. Cryptocurrencies are going to be accepted as a financial market rather than a fringe market. And this is just going to be an explosion of opportunities to make money. It's a good thing because we're in a digital economy, which means we're no longer a consumer-based economy like some other nations. And so the bulk of the wealth and the bulk of the money that you can make won't come from a wage or a salary. It will come from learning how to trade and invest in the market.
That's a really interesting approach too. And I like how you're mentioning multiple asset classes there. And for our beginners out there, I think it's very important to hear that, right? Because a lot of times we can get stuck into, let's say, just equities and not paying attention about all the other opportunities that are available to us. Exactly. And so leaving off here, the last thing I would like to ask you, Martha, is what can traders maybe be looking for in TechniTrader to really kind of take themselves to that next level?
Well, I'm really catered to a specific market niche. I call us a boutique operation because we are really trying to find those who want to trade as a business. The IRS has a special rule now, and you are treated like a professional. You're able to take off the cost of your courses. You're able to take off all of your expenses, where hobby traders, that's the IRS's term, can't. So if you just want to play and have fun in the market, that's great. But I really cater to those who are very serious about becoming semi-professional to professional traders and making very high incomes from the market with a very high consistent rate. Professionals have a 95% success rate. They only miss 5% of the time. My students stay on a simulator until they're 70% successful or 75, and then they move up to 80 and 90, and then a lot of them end up going professional.
Love to hear it, and I love the step approach. We talk about this a lot on our live trading stream, and I hope that you guys take a look into TechniTrader. We'll make sure that the description right there includes the link, and also in the chat. Catch it, guys. Like always, it was a pleasure having you on today. Of course, Martha Stokes, CMT, co-founder, CEO of TechniTrader. We'll have you back on. Thank you for coming on today, Martha.
Thank you. It was great fun.
All right, team. I'm excited to keep things going, of course. We brought on the best for you guys. So, of course, let's get to Sam Stovall here, Chief Investment Strategist at CFRA. I'm sure everyone has seen Sam before, but welcome back. It's great to have you.
Hey, Mitch. Good to talk to you again.
Excited to get into it, of course, and the markets are definitely feeling enthusiastic. I'm feeling the enthusiastic in the market. It's the holiday time, right? December, it seems like it's usually a good month seasonality, and wouldn't you know it, good old Santa Claus Jerome Powell, I'm going to call him, because it seems like he came with presents yesterday to start the December FOMC meeting. Of course, he took a surprising dovish turn. And I thought that was definitely a surprise, with Powell declaring inflation easing, rates cuts possible in 24. That's quite a change of tone from where we were, let's say 6 or 12 months ago. What did you make of this pivot towards what did you make towards these pivots and the implications for the financial markets moving forward?
Well, I think most people in the financial markets pretty much assumed that the Fed was done with their July 26th rate hike, and that really we were just sort of biding our time, waiting for the economic data to confirm that no more hikes are needed. But I don't think anybody really expected the Fed chair to come out and actually say that, or at least intimate it as such. Yeah. And then to go one step further to say, yeah, we think that we're probably going to have 3 more rate cuts in 2024. So I think those two factors together really sort of lit the afterburners on this stock market, pushed us dramatically higher, mainly because Wall Street remembers that in the average 11-month period between the last rate hike and the first rate cut, the market has been up 16%, bringing along with it all styles, sizes, sectors, and nearly all of the sub-industries.
It's impressive, and I can see the market breadth getting better every single day. I know that a lot of people put it on the Magnificent 7, and that's why this rally came. But even if you take a look at the RSP, I mean, you're really starting to see everything catch up. Is that what you're seeing, Sam?
Absolutely. I like to look at sub-industries. There are 153 sub-industries in the S&P Composite 1500. That consists of the large cap 500, mid cap 400, small cap 600. And right now, we're looking at nearly 90% of these sub-industries trading above their 10-week or 50-day moving average. About 2/3 are trading above their 40-week moving average, which is equivalent to the 200-day. And about 60% plus are above both of those indicators. Now, these numbers were substantially lower in the latter part of October, and we've seen a complete reversal. And then also, if you take a look at the percentage of companies in the 500 in positive territory, again, we're looking at a number that's 60% or higher. So maybe the Magnificent 7 provided the bulk of the growth, but I think overall a rising tide has certainly lifted most boats.
Yeah, and let's talk a little bit about what led to this, right? Of course, talking about the positives and the promise in AI, and it really seems like it's driven a boom, not only in, let's say, NVIDIA's stock price, but in productivity overall. And I think that this is what some are maybe missing out here. So where do you think AI could really move the needle most in your view?
Well, our tech specialist, Angelo Zeno, is very optimistic on the AI space in terms of the concept, but also in terms of the individual companies that are in the forefront right now. companies like NVIDIA, like Marvell, et cetera. And basically the feeling is that we are just in the embryonic phase of this kind of growth. And obviously people are optimistic because it just seems like the future is, obviously the future is ahead of us. That sounded like a Yogi Berra-ism, but rather just to say that the growth potential right now seems to be unlimited. Of course, the stocks really trade more on their earnings, not just on vapors. So you want to make sure that these companies do offer earnings and revenue growth. But we are very optimistic on this space in the near and longer term.
I love it because I've been making mentions and I'm like, show me the money, right? The classic line. But the truth is, that's what we want to see from all these AI products, right? Actually, it's showing up in the bottom line, showing up in revenues. I know that's what I've been looking for. I mean, the underlying assets like NVIDIA, that can be expected. But everyone that's on this build, I'm looking to see what's going to show up there.
Oh, sure. Well, now, even the old style technology companies like IBM are talking about AI. And certainly, AI is found in a whole variety of things, from the correcting the spelling errors on your iPhone to, your driving and coming up with GPS and so forth and so on. So really, I think what's going to happen is you end up with a much greater efficiency, higher profit margins, and so longer term, it's AI is going to be A-OK.
Let's talk about the resiliency in this economy. It seems like it just can't be stopped right now. Even though a lot of people were expecting the consumer to face some struggles, and a lot of people were yelling recession just maybe even a week ago. Where do you see the economy and the resiliency? And could this just continue just chugging along?
Well, we have been saying for a while that we thought a soft landing was the most likely scenario, mainly because of our economic projections that, yes, we're likely to see only about a 1% growth in GDP for the final quarter of 2023, as well as the first 2 quarters of 2024. The 5.2% growth that we got in third quarter, in a sense, was an anomaly. Also, remember, it is a quarterly number that was annualized. So it's not like we've really been seeing that kind of growth year over year. So we're expecting a slowdown because, let's face it, when you have increased interest rates as quickly and as dramatically as the Fed has this time, it's bound to show a slowdown. But the consumer remains resilient. We saw that with the retail sales. We also see that in the employment records, et cetera. So our saving grace, if you will, is the consumer's interest and willingness to spend. And so we believe that that's going to carry us into a soft landing rather than a recession.
Yeah, of course, it always seems like there's the next risk around the corner. But even in an upside scenario, right, what worries you the most in terms of growth outlook next year? Is it maybe financial instability, persistent inflation coming back, maybe some fiscal cliffs coming in here? What do you see, Sam?
Well, I guess the headline worry that we focus on, because 2024 is an election year, is what kind of upsetting of the apple cart will the politicians do? I like to say that if the opposite of pro is con, then the opposite of progress is Congress. So I think that Congress is going to make more headlines than they will adversely affect bottom lines. So what really keeps me awake at night is to see, could we end up with a 180-degree turn in this economy? And rather than having a slowdown in economic growth, we do actually stumble into a recession, because that would, in a sense, turn on its ear those sectors that are starting to see an improvement, in particular, financials and real estate. These are the ones that are taking a leadership role right now because the Fed has finished with its rate tightening program. They're the ones that tend to lead in that space between the last hike and the first cut, and then also looking to how actively the Fed is likely to lower interest rates. We're looking for 3 cuts in 2024, starting in the second quarter. If the Fed does actually cut by as much as the market thinks, which is 4 to 5 times, that implies that there's something really wrong with the economy and it needs to have a floor put underneath it. So I would actually worry if the aggressiveness of what the market is building into share prices in terms of rate reductions actually comes to fruition.
Yeah, and one of the things that I always look at, especially this time of year, is looking at the sectors and their year performance, right? I remember last year, there was still a lot of people that were negative on technology, but yet, of course, we all know how that came this year. Where do you see kind of the sector outperformance maybe going towards next year? Is it maybe some of the losers of this year, utilities, healthcare? Where do you see it?
Well, you know, I'm a numbers nerd, so I try to figure out what is the typical pattern that takes place. In the beginning of 2023, I had written that because we had a down year in 2022, down 19.4%, because we had a positive January barometer, and because the first quarter low did not exceed the prior December low, that was telling us this is going to be a surprisingly strong year because the market on average has risen by 25% whenever that has happened and has never declined since World War II. Taking that one step further, following down years, I have found that you are better off rotating from first to worst, meaning move out of those areas that held up the best during the market decline, such as consumer staples, healthcare, utilities, and gravitate toward those groups that were beaten up the most, such as communication services, consumer discretionary, and technology. And surprise, surprise, they are the significant outperformers this year. Okay, Sam, thanks for telling me what I should have done last year. What am I going to do this year? Well, following up years, and certainly 2023 is an up year, history tells us that we are better off letting our winners ride by owning the top 3 sectors based on an up calendar year into the new year. That average return has outpaced the market by about 200 basis points per year, has posted a positive return 82% of the time versus 73% for the market as a whole, and beat the market 7 out of every 10 years. And this goes back to 1990, which is as far back as S&P has sector level data. Digging a little bit deeper, if you were to hold on to the 10 best performing sub industries into this new year, outperformance has averaged 800 basis points, and this strategy has beaten the market 73% of the time. So a good encouraging stat that I would say is a good guide, but not necessarily gospel. But it basically does say that following an up year, you want to let your winners ride.
I love it. And you guys heard it here, Sam, and going through the history there. I love that approach. And yeah, even maybe talking about technology this year, I don't think it's such a bad thing because we need to be looking for that information. And right. And I don't think there was many people talking about understanding that could have gone right back to the top. And that's what history books say. Like they always say, right? History doesn't repeat, but oftentimes it's going to rhyme, right? So I think in this case, it was definitely something to learn from because that was the first like true bear market that I was able to trade through. And for investors that were able to trade and newer traders to go through that, I think that's definitely a lesson that we'll have in the back of the book and be ready for the next opportunity, right?
Absolutely. And if you are a very long-term investor, then yeah, maybe you do want to take a look at some of those groups that have really been beaten up. If you're an older income-oriented investor, then maybe some of those utilities or some of these dividend aristocrats, if you will, that are paying a dividend yield of 3% or more, payout ratio less than 70%, that have an S&P quality ranking of A minus, A plus. They could be things worth buying and holding for an extended period, but at least for the coming year or so, you're probably better off. As I said, you let your winning sectors ride. Maybe you sort of dip down into the second or third tier within that sector, those groups that are not among the Magnificent Seven that therefore could have more upside potential, or maybe even look at what I would call the honorable mention groups, such as financials, industrials, and real estate.
I love to hear it. And I know that you're all about industries, right? And so I would go ahead and pull here. What is maybe an industry that most don't hear of every single day because maybe it's not at the top of the headlines, but could be a great opportunity going into 24?
Well, an area such as the hotels, resorts, and cruise lines, that's one of the top 10 groups in 2023. And we have a buy recommendation on Hilton International. So that hotel chain is one that could do relatively well. Sort of a dull sounding name like trading companies and distributors. So Granger could be a stock that should do well in 2024. A lot of the other names are your traditional technology areas such as application software, semiconductors, technology hardware. But probably another name that might sound a little boring in the construction and engineering group is Quanta, ticker PWR, that could end up doing relatively well in 2024.
I'd love to hear those names because, to tell you the truth, sometimes, everybody talks about the sexy names, the Nvidia, the Apple, your Tesla, but sometimes it's the one that's forgotten. It's kind of has that a lot, the risk minimized, and you can just kind of ride these waves. So those unknown names, thank you for bringing that up. Like always, guys, you guys can keep up with everything that Sam does. Of course, check out CFRA and everything they put out. What else can they be doing, Sam, to know more about the coverage that you provide?
Sure. Well, thanks for the opportunity. If investors were to go to our website, CFRAresearch.com, you could get a free trial to our wealth management research called Market Scope Advisor. There we have buy, hold, and sell rankings on about 1,400 stocks around the globe. We also offer ETF research. And the research is not just looking backwards 36 months and saying, what's the risk-adjusted return? But we apply our buy, hold, and sell rankings to all of the companies within that ETF to say what the forward-looking opportunities are likely to be. We also have a technical research service called Lowry, and there you could get a free trial to that technical analysis service. So check out CFRAresearch.com to see if there are things that could be of interest.
Hey, love to hear it. Looks like Jerome's not the only one bringing presents. Thank you, Sam Stovall, of course, Chief Investment Strategist, CFRA. Always appreciate you, and thank you for what you've done for us in 23. I want to give you a thanks from everyone out there listening, and looking forward to seeing your coverage in 24.
My pleasure, Mitch. Thanks for having me on, and happy holidays.
Happy holidays indeed, man. Take care.
All right.
All right. Welcome, guys. Let's get into, of course, our outlook for 2024. Of course, I'm joined today by Thomas Hayes, chairman of Great Hill Capital, and Michael Lee Strategy. You guys are the best. So I came to the best and got the experts all together. I want to hear it from you guys, of course, from the upcoming roller coaster political landscape that we'll be having in 2024. How do you foresee governmental decisions impacting the stock market? And if, let's say, certain political developments happen, what should investors be closely monitoring for potential market effects and opportunities?
I think there's a lot of noise around political investing. And what I've found in my years in the business is that on balance, if you bet on the basis of a political view, you lose. The number one thing that needs to happen from an investing standpoint as it relates to politics is gridlock. I mean, you basically want to keep any one party from doing too much on the extremes. And the market kind of likes the inability of government bureaucrats to do too much to impact or slow down the beautiful growth engine that American business is. The biggest risk would be if any one party gets the executive, Congress, and Senate. If you have one party that controls all three, that's an investing risk.
Yeah, let's continue the conversation and go to Michael.
Yeah, so right now, if you look at predicted, the betting markets for President Trump and Biden are tied. They're both at like 40 cents to be president in the next election. What I would say in terms of that is the surprises we got in the election in 2016 are unlikely to happen again, because I don't think the market will count out Trump the way it did in 2016. So that explosion we got in markets is so people didn't really have their hands around it. I would disagree with Tom in that. I think the Republicans are going to win all three. I see a deteriorating consumer over the next year. And when you like try to handicap this out in that you have the working class, so people in the bottom third to the bottom half of the income stratosphere are overrepresented in the electoral college, and so the consumer in the top 5 or 10% has weathered this economy and flourished dramatically. Right, it's those kind of in the bottom half that have been crushed, and that's where you're seeing the shift in the polls, where Trump lost all these Rust Belt states in very small margins, but in the polls leading up to it, he was down anywhere from 5 to 10 points. Now he's up 3 to 5 points. And I think the factors that have led to that, mostly inflation, because it's not, partisans like myself that decide elections. It's low propensity voters that don't really pay close attention. Like, is this going to motivate them to go out and vote for candidate A or candidate B? And I think it's this kind of crushing inflation that's going to make the difference. When Trump is on the ballot, Republicans turn out down ballot in record margins, as you saw in 2020 and 2016. So I think they end up with all three houses, but I don't think it's as big a surprise. So I would say that's a net positive, but from a macro standpoint, I see things continuing to deteriorate over the next year. I think the government's been cooking the books on employment data, and so that once those chickens come home to roost over the next 6 to 12 months.
Excellent. Now, of course, this all leads to a big decision that will definitely have to come from the Fed. And do you anticipate any significant shifts or pivots from the Federal Reserve's monetary policy in 2024? And how might these adjustments actually influence the dynamics and investor sentiment?
I think the market has gotten a little bit ahead of itself in terms of how many cuts they expect before next summer, cuts starting in March. It's possible when you look at the 2-year, it starts to kind of lead things in that direction. But I'd be more inclined to see at the end of the year maybe 1 to 3 cuts, and probably back half loaded versus front half loaded. We're slightly more sanguine than Mike in the sense that earnings have been about 300 to 400 basis points too pessimistic going into each quarter for the last 3 quarters. We do think that trend is going to persist, and that we do think that 2024 earnings are probably somewhere in the ballpark of realistic at 245, which would be 11% earnings growth. So on balance, we're pretty constructive, and in that context, the Fed might have to do less easing than the market is already anticipating.
I'll go to Michael, of course. And do you expect a pivot in 24?
So, yes, the size of that pivot is the question, and I think if we don't get a pivot, it's because this recession that people like me have been predicting that I thought we were going to see sometime in the end of the first quarter or middle of the second quarter just hasn't arrived yet. And if it hasn't arrived yet, it's because inflation is still high. Earnings look pretty good. I don't know how that happens. I think what a lot of this year's earnings growth has been NVIDIA. So the only way, in my opinion, they're going to cut is with material economic weakness. And so the market is it's kind of damned if you do, damned if you don't, in that the way that we get rate cuts is if this job market really starts to fall apart, and it doesn't happen. You either you kill inflation with the recession or you don't. And if we don't kill inflation, rates are probably going to stay pretty high.
Yeah, and I'd have to call on you guys to maybe do a little bit of a grade on the job that Jerome Powell has done as chairman, at least in his inflationary battle since the pandemic. What would you guys grade him?
Go ahead, Mike. You can start.
Oh, like a total and complete failure. And it's the situation we're in right now is much of their own doing. And like I'd say in dealing with the uncertainty of the pandemic, A+. But the pivot to move away from the sort of this unprecedented aggressive policy just took too long, and it created a lot of the situation we're in.
Michael, what's the grade? Do we give him an F or does he get a D?
Oh, F for me. Tom, what do you think?
F for failure there.
I don't know how much you guys attended the Berkshire annual meetings, but I'm going to take a Charlie Munger and say I have nothing to add to Mike. I would say I would just add one thing. I think Mike gave Powell too much credit for the pandemic rescue. I would assign a lot more credit to Mnuchin, who was probably one of the smartest public servants we've ever had in the history of the country.
Something's got to change. We'll see if it changes in 24. Let's talk about promising opportunities for next year, right? What are some particular sectors, industries, or maybe even just type of investments that you see as promising for 2024? Let's start with Michael this time.
Yeah, so we start talking about artificial intelligence and the artificial intelligence stocks. And obviously everybody's favorite stock is NVIDIA. You look on your screen, it looks like, I think they updated the PE to like a 60 from 120. The reality is like NVIDIA's going to do close to $100 billion in revenue next year, and they're going to net close to 50. So the stock's trading somewhere between 20 and 25 times earnings. And the overhang on that stock is what is the AI tech spend going to be in calendar year 2025? And so from what I understand is the hesitance in the hesitation in the hedge fund community to push the stock higher is they don't know, right? Because we are not in the first innings of this artificial intelligence. We don't, besides NVIDIA, no one's made any real money from AI. It's only NVIDIA.
I've been saying it. Show me the money, right? Show me the money, because it isn't the underlying chips behind it, but are we actually seeing revenue come to the bottom line?
Right. And the way I like to describe it is with NVIDIA, it's like you look at AI as it's this big gold rush of a mountain, right? And NVIDIA is simply selling pickaxes right in front of that mountain. And so the other problem that NVIDIA faces is when a corporation needs to buy a lot of a specific part, you can't buy 100% from one vendor. So you need to have some sort of redundancy, some sort of backup to fill in for them. And so the biggest beneficiaries of that are going to be AMD and Marvel Technologies. And so I think Marvel, because the revenue opportunity for them to go from a 0.25% market share out of a $100 billion market to 1% and 2% is very meaningful to their top and bottom lines. So if they pick up $1 billion in new revenue from chip sales for AI next year, that matters to this company because they're only doing $6 or $7 billion in total revenue. Whereas AMD, it's a larger company and they'll probably pick up similar market share as we move forward. But I think this is one where the buy side and the hedge fund community is wrong because everything we know about AI is exponential growth. And the gas really only got turned on with this tech spend in AI towards the end of the first quarter of this year, and we see what it's become. And so the bet on NVIDIA and why it's kind of stuck at $500 is that we're not going to see this continued exponential growth, which I would say, like, if you look at how fast we've moved in 6 to 9 months now, think about where we'll be 6 to 9 months from now. So to me, NVIDIA is an extraordinarily cheap stock. And these other two names are going to capitalize on this, but they are a clear head and shoulder leader in the market. And that, that stock, I think, could be a stick in the mud until you have some sort of clarity into what that tech spend is going to look like in 2025.
And of course, let's go to Thomas. I know that you're ready for this. Where do you see opportunities in 24?
I think we're going to see a continued broadening of the participation. So, Mike is more of a momentum. I'm more of a turnaround guy. Some people call me turnaround Tom. I like things.
Got to find the turn, baby.
No one likes. Look, the S&P is trading at 18.9 times forward. So that's kind of, a lot skewed by the Magnificent Seven. Mid caps are trading at 13.9 times. Small caps are trading at 13.2. So on a relative basis, I want to have some exposure to small and mid. One name we like as a turnaround is VF Corp. They've got North Face is growing 20%. Vans is contracting 20%. They're going to fix that. Timberland, they've got Dickies, they've got Supreme. I know Mike wears a lot of Supreme. Here's the deal. They just brought in this guy, Bracken Darrell. Bracken Darrell came into Logitech in 2013 when the stock was down 85%. If you put $5 million in when he came in, within 8 years, you had 133 million. He had a 26 bagger. The guy knows how to fix broken projects. He's just come into VF Corp. I think he's going to turn it around. I don't think it'll be a 26 bagger, but I think it'll be a multi-bagger. He's brought in a new president for VF Corp. He's applying the EU platform. They're growing like gangbusters in Europe. They're going to apply those techniques into the US. And then they're going to sell off the PAX business, JanSport, Eastpak, and they're going to use that to deleverage and invest in growth. He just did his kitchen sink quarter, and the stock is starting to take off from that. I think it got down to like 14 or 13. It's now 18. And I think we're going to be off to the races, and this can be something exciting. One I think I talked about with you a year ago when it was $5 is a auto supplier called Cooper Standard. That had refinancing risk at 550. It's now 17. We think it's just getting started. We think if car production gets to 85% of where it was in 2017, when it was $146 stock earning $7 a share, this thing can be a multi-bagger even from here where it's already tripled. And then finally is Crown Castle. They've got 40,000 cell phone towers. Elliott, it's a play on rates. Okay, so as rates come down, REITs and utilities are going to do well. Two, you now have an activist in there with Paul Singer at Elliott, and he basically said, he wrote a nice letter to the board. He said, I'd like to fire you. I'd like to fire your CEO. And by the way, Mrs. Lincoln, how was the play? Other than that, wants to sell off the small cell and fiber business, which their competitors that have outperformed them did not get into. Sell that off, and then let the legacy tower business generate huge return on invested capital. If they're successful, I think even though it's already moved 20%, I think it can work its way towards 200 over the next 24 to 36 months. So those are kind of the plays that we like in the turnaround and SMID cap space.
All right, let's wrap it up with, of course, the big R word, and we'll do it on a percentage basis for recession in 24. Would you cue that up to 90, 100? How do you guys see it? Let's go first to Michael.
I think there are parts of the economy that have been in recession, right?
Okay.
For certain segments of the economy have been in recession since for 18 months now. And what you're going to see, and I think what the phenomena stopping us from having a quote unquote official recession is the massive amounts of government spending. And this, I'd say an official recession where you have 2 quarters negative GDP growth, I'd say that's about roughly a third that we see that this calendar year, simply because a lot of that infrastructure bill that was passed in 2021 is going to start to come online, and like the massive amounts of government. That's kind of like, whereas if you take out these one-time government spends, like you're clearly there, and it's a tale of two economies. So for many in smaller markets on the tertiary, it's going to feel like a recession as it has. And so you're already seeing that in a lot of the, what you call quote unquote soft data, the ISM surveys, and some of the regional manufacturing surveys. Like some of these comments from respondents are horrific. And you're seeing things that you haven't seen since 2008 or March, April of 2020, whereas we could skate through this and have this, Bigfoot soft landing where it's really just one-time government spending that messes with the calculation. So I'd say it's less than the probability of an official recession is far less than I described with the deteriorating economic data, but nonetheless, it's still ugly for a large segment of the economy.
All right, let's go to Tom and we'll wrap it up. What are you feeling here, Tom, for recession and the percentages, chances of it being a recession in 24?
Yeah, I think Mike's right that we've had these rolling recessions going for a while. Manufacturing has been in a recession for, a couple of years. We kind of had a tech spend recession in 2022. We actually had a technical recession. The thing that I said a lot, like Q3, Q4, Q1, 2, 3, 4 of this year, was that everyone's waiting for a recession that already happened. And, we did have a technical recession in 2022. But now, we've been running for a while, so I could certainly see some softness in 25. But 2024, the odds of another technical recession like we had in Q1 and Q2 of 2022, and in Q2 and Q3 of 2020, I think are very low. I mean, 15%, 20%. It remains to be seen, but pretty sanguine on 2024.
Yeah, being here in downtown Detroit, I mean, you guys can see it right behind me. The people skating. I mean, everyone's out and about shopping. The holidays are doing great. So,
how about that office? Is it filled or empty? What's the story?
Oh, we have a pretty good filled office. I'm actually going to do a shot. You guys will see this, and I'll do a little bit of a. We have a camera on the ceiling there. We'll take a look at the office and show everybody. But it's great to have you, of course, always. Michael Lee from Michael Lee Strategy. Thomas Hayes, chairman of Great Hill Capital. Some of my favorite follows definitely on Twitter. So if you're not following these guys, you're definitely missing out.